Welcome everybody to another Sunday session. Great to see everybody again. We're heading into the summer season here, spring and summer. I think I'll discuss in the next couple of slides here why we are actually in the summer when it comes to oil demand, which I think for some of us, our lifestyle revolves around some of the more other definitions of summer with regards to our investments as well as our general life. Being a pretty interesting week, a little bit more stable than the previous, but still lots of pontification, lots of interesting comments being made about what is happening. The world collapsing narrative, I think, has continued. It will always continue. That's just how things are, but seems to be stabilized a bit. We saw open interest in WTI and the crude futures drop significantly. So definitely a large paper market impact. I do hope to discuss that more deeply in the future, but I did discuss that on the two interviews that got put out last week. Both revolve around the banking and the credit markets and the financial impact of what's going on as well. But overall, the physical market looks good. I shared a few charts last week on the Sunday presentation before I began the rest of the Q4 review, talking about global supply and demand. And I'm going to be sharing just a couple of charts here as well. I had mentioned this earlier, but the macro presentations are now going to be every 6 months rather than every quarter, just because we've covered a lot of the major topics. They're already out there, and it's just easier rather than repeating same things over and over. So every Sunday presentation that I do, I'm going to be doing an update. So 3 to 5 to 10 slides on the macro. That will just keep people in the loop as to what's happening rather than a full-on multi-hour session every quarter. So yeah, today we have global offshore production and development forecast, something that is a little bit of a twist to my presentation schedule, something that's a bit different. Not something that I've ever worked on or have any specific expertise on. Today's presentation is going to be more of an overall overview, a aggregation of sorts, so that we can look at the industry as a whole. I may have mentioned this earlier on one of the recent podcasts as well, where deep water drilling and even your shallow water drilling and supply are going to be some of the supply factors to watch for going forward. When we talk about stable, long life, low decline supply, along with the oil sands, we have the deep water offshore and the shallow water offshore. Shale is not really your stable base of production that is going to work in a world that continues to consume more and more petroleum every single year. So an overall overview, we're going to talk about some of the countries that are the main ones. We are going to talk about some of the areas that are the main ones, and then some of the E&Ps that are major in this. Keep in mind, offshore is an expensive game. This is not something some random company is going to launch and then say, we're doing a development here or there. This is really a game that the majors and the state-owned oil companies, the NOCs or the IOCs, really excel at. That being said, there are changes that I want to discuss. So I will be discussing a few of my own insights as to the success rates of wildcat drilling, where the global offshore service market is going. We will discuss some of the production issues that are happening, as well as a topic I find very interesting, which is the optimism. When it comes to oil demand, it seems like investors are needlessly pessimistic, where they say, well, renewables, and I'm not saying oil investors, I'm saying investors in general say, well, renewables are going to come online, EVs are going to have this massive ramp, solar is going to do this and that. But then when it comes to oil supply, the average investor is unnecessarily bullish, saying, oh, the North Sea can put out multi-million barrels, shale can do this, and Africa has all this oil, and Saudi can do that. And it's like none of this is really rooted in deep understanding of the science and the geology. And I'll prove it, because for the past decade or so, there's been various different estimates that I will share that said production in a certain area offshore is going to get to some level. and it never did. So we have to keep our own biases in mind. We have to keep the average investor's biases in mind, which of course is reflected in the media and what they put out. So with that, few things up front before we begin. I'm not an investment advisor. Everything I share today is my own opinion. So please do your own due diligence as to what you're seeing today. If you are curious on any of these topics, there is more information online, including very technical presentations and seminars and SPE papers that have been written about various topics here, because these topics are of global importance. The global oil and gas offshore market is a major player in oil supply and is going to be an even bigger player in oil supply going forward. Please also check your own risk tolerance. When it comes to offshore, we are talking about long lead projects that are multi-years out, could be multi-decade long production cycles. And then we're also talking about some of the exploration companies. So when we talk about oil exploration, it inherently comes with higher risk in terms of your chance of success. It also comes with high reward. If you are able to hit a massive pool of some kind, of course, it's going to be worth a lot more than any onshore discovery, especially at this point in time. Also, please check your own portfolio construction. This is something I've been stressing more and more. I notice certain individuals reach out to me and say, hey, I've got so much percentage of my company or of my portfolio in these high flying juniors or options or whatever else. The cycle could work out exactly as we think it will, exactly as forecasted. And if your portfolio construction is not correct, you could either end up losing money or not taking advantage of the cycle as much as an investor potentially could with a different set of portfolio construction. I also have a mailing list. So anybody that would like the Zoom links before 1 or 2 days before the session, please shoot me a DM or an email. We can get you on the Zoom link. Or on the mailing list. I will once again say this because there's a lot of emails that are bouncing back. So I'm not entirely sure why, but like when I was adding files, I understood why some of them were bouncing back, but there is about 5% or so of them that still come back with an error. So maybe something I will reach out to certain people and get it addressed. The Zoom will be recorded. It will be on YouTube, hopefully right away. Like I said, they've done a really good job at processing video. Whatever they've changed in the last month, the algorithm is doing really well. So kudos to them. That will be on there. And then the Twitter space obviously is recorded as always. I'm not entirely sure how long Twitter is keeping them these days. Used to be 30 days, but it will be on there as well. And we will have the offshore presentation. Then we'll talk a little bit about, we'll begin with 3 or 4 slides on macro, then talk about the offshore production and development. We end with a little bit of offshore services, and then we'll get into a brief Q&A session where we can discuss any other topics. I will say I cannot take questions on Twitter Spaces, just given the way the audio records on Zoom. It just doesn't work. So apologies for that. But of course, it's a good time to say if you are on the Twitter Space and you would like to join for the Zoom, whitetundra.ca, scroll to the bottom under events, and you can join us for the visuals. If not, feel free to listen in on this very nice Sunday. So what has changed when I talk about summer and what it means to investors? Since the beginning of the year, I have sort of identified that, hey, global jet fuel demand is going to be your major factor this year. It is a factor to watch in terms of global oil demand, where it's picking up, how the economies in the world are doing, the recessionary impacts, the impact of inflation. All of this can really be felt in the global jet fuel market, primarily the Asian jet fuel market, which is finally rebounding as of the beginning of the year. And now, today, March 26th, 2023, is the first day of the IATA summer season, the International Travel and Airport and Airline Authority. It's their summer season. So what does it mean? There is more slots that open up at airlines there is more slots that open up within airports. You get more agreements from the authority that, hey, it's summer, we are fully staffed, we have our air traffic controllers fully good, we have our baggage handlers good, we have our TSA and security is good. You can now increase the number of flights that you're allowed to use per day. Airports are allowed to allow more flights into and departing their facilities every single day. This is a legit change. There is about a 5% increase right away, 3 to 5% increase in the number of flights that are active on a daily basis today. It changes in one day. It's not over a period of time. It changes in one day, and then it accelerates as the year goes on. All you have to do is pull up Airportia, Radar Box, Flight Radar, whatever you want to use. Look at the global flights per day. There is this bump that happens in early March or early April or late March, and then it just continues. So that is your European travel season. That is your Caribbean travel season. It is your traveling within airports within Asia. It is also the North American increase in flights internationally. So major change. And this is the table I want to share here. Capacity change between week of 13th March, 2 weeks ago, and week of 27th March, which begins tomorrow. You see some of the local Chinese airlines, their capacity is up more than 40% in just 2 weeks. So Qingdao Airline, Chengdu Airlines, Tibet Airlines, Air Cairo out of Egypt, Norwegian Airlines out of the Scandinavian countries. We have Jet2, we have Ryanair, which is a local domestic low-cost carrier, Korean Air, Wizz Air, Eurowings, Austrian Airlines. These are all up more than 20%. The ones I mentioned earlier are up 40% in just 2 weeks. So not only is large domestic capacity going to come online within Europe and within Asia and within China, you will see a large increase in the overall international flights. They're not going to show up here because Delta or United or China Southern is not going to increase their capacity by these percentages since they already run 2 to 3 to 5,000 flights a day. So less percentage, but more from an absolute number of flights coming online. When we look at what are the capacity evolution for the summer season, people will be surprised to hear China is up 15.6% for this summer season compared to 2019. So we have so much discussion about China is not reopening, they're not reopening. Well, they never had the flight capacity to do so until we transitioned into this summer IATA travel season, which we're now in. So expecting a huge demand increase here, a huge number of jets increase. I ran a calculation, a rough calculation that said, hey, if we get 3% increase in flights, which is the lower end, would be about 2,500 to 3,000 flights that are being added. The average plane, let's say, is in the air for 6 hours a day, 18,000 hours. And the average plane consumes about 20 barrels an hour. So 18,000 hours of flight time times 20 barrels. We are at about 360,000 barrels per day of jet fuel increase just today. On top of this, we have the acceleration of jet fuel demand, an increase of that as the summer continues, as we get into April, May, June, July. So watch for a nice little inflection point here on jet fuel demand. I was laughing so hard because just last week or the previous 2 weeks, I saw these articles saying there's excess jet fuel in Europe, there's excess jet fuel in Asia. And I'm thinking, do you not realize that they are setting up for the summer season kicking online and you're just putting out these articles without understanding why that jet fuel was in a glut for those 2 or 3 weeks? So really bizarre as to the media and the reporting on some of these things, because they report the raw absolute data without reporting the caveats behind it, perhaps trying to mislead, perhaps just ignorance. Either way, the US summer capacity is going to be up 5% this year compared to 2019, India up 14%. And then some of the European countries are below. We have Germany minus 19. We have Japan minus 12% compared to summer of 2019. So still expecting some more rebound there, especially as these European carriers get back on the market. Here is the same, exactly what I described, backed up by data, backed up by forward-looking jet schedules. You see the domestic number of seats per week is rising about 2 to 3 million seats in just 1 week, which is, of course, us going into the summer schedule. We also have international flights rising about 10%. So about 3.5 million international seats per a week are coming online today as we speak. And this is expected to continue rising another about 10 to 15 to 20% over the course of the summer, which is your high jet fuel demand flights. An older Boeing that goes from New York to, I don't know how the schedules are these days, but let's say a 12-hour flight on one of those large Boeings consumes about 500 to 700 barrels on one flight of jet fuel. So really, really large consumers are coming on the market as the summer continues and the jet fuel kicks on. Here is what they say about the winter season. The winter season ended on March 26th. We are now in the summer season, and the date allows airports to make transitions such as Heathrow lifting its passenger cap. This is from last winter, but the same methodology applies. The other thing that's changed this year is for the last 2 or 3 years, Europe had allowed airlines to not use their slots. They said, hey, even if you only use 75% of your slots, the COVID years were even lower. They said, that's fine. You don't have to run the planes every single of your slot times. We're okay with it. Now they're saying, no, if you want to keep your slot at our airport, you have to run it at least 80% of the time. So they're forcing airlines to run more schedules. Of course, given the world has reopened for the majority part, a lot of these flights should see higher utilization anyway. But at the same time, airlines can't just say, hey, we actually don't want to run these slots anymore. We don't want to run these schedules anymore. We're just going to sit tight and relax. Not going to be allowed. So by nature, you should see higher jet fuel and flight schedules in the European area because of this waiver that was granted for the last 3 years. So I will repeat this again. International jet fuel and jet fuel in general is a major, major proxy to watch. It tells you a lot of things, not in detail, but it tells you how the general economy is doing, how the general COVID situation is, how the general inflation impact and the impact of higher jet fuel prices is, how the pilot shortage is doing, how the overall baggage handling and security situation is. You can get a pretty good idea as to how that's playing out. And these forward-looking jet schedules, this is a free resource that tells you how the schedules are looking forward. And all you got to do is take the number of seats per week, divide it to the day, take it to the number of flight hours, increase that becomes, and run it by your 20 barrels per hour of average jet fuel consumption. And there you go. You will have a understanding of how much jet fuel is going to increase from here on out. So, the people that are arguing with me saying you're wrong on jet fuel and it's not going to increase by 1 million barrels per day, run the math yourself. The graph is right in front of you. Run it to the peak summer, and it's going to be more than 1 million barrels per day of extra demand is what we end up at from, of course, yesterday now, because today was a major increase as is. So I will leave that there. That's kind of the macro side of things. I had discussed the Chinese inventory and the Chinese import last week. Happy to report nothing has changed there. The last week was another 81 million barrels of crude import from China. So we're talking about 11.5 million barrels per day for the last 2 weeks now in a row. And that is about 1 million barrels per day higher than China has ever imported. So looking pretty good here moving forward. And at the same time, Chinese inventory is not rising. So that tells me they're consuming all the oil rather than just keeping it for storage. So anyway, I could talk about macro on a different space. So I will leave that for there. On the global offshore topic. So once again, before I start, for anybody new that's joined, I just want to say this is something that's a little bit different than our previous sessions. This will be more of an informational session. more of a data aggregation session as opposed to any unique insights that I can provide because I've never worked offshore. It's more to give people who have no understanding of offshore some threads to start off their research, something to begin on, and something to focus on for major supply going forward, because really in an undersupplied structural bullish outlook, it is supply that we really need to watch. So here is our global crude and liquids production graph, mostly crude. So onshore, pretty stable. It's risen a bit in the mid 2010s because of course, shale coming on the scene. So 15, 16, 17, 18. Still, we're seeing an overall flat to declining graph that shows up on onshore. Our shallow water production is relatively flat. So basically in decline mitigation mode at this point. We are into the crux of the Hubbard's curve, where we're just basically maintaining our shallow water, which is our easier offshore oil to access. It is our cheaper oil offshore to access. We're just basically maintaining it flat. It's really your deep water that's gone up materially. So in, let's say 2005, your deep water production was about 2 to 3 million barrels per day. In 2015, we were up to 7 to 8 million barrels per day of deep water. And in 2020, we're now approaching 10 million barrels per day, which is about 10% of global overall production is now coming from deep water. So always pay attention to trends. When you see trends like this develop, it's very obvious as to what's happening. And yeah, one graph doesn't tell you everything, but it allows you to realize, what should I focus on? What are my main points going forward? If I'm looking at global oil supply, in order to fix this undersupply in the market, where is it going to come from? Where has it come from in the last 20 years? So definitely a nice, very clean chart. I do like this. This is another one that breaks it all the way up to 2025. And a very interesting chart because I think it's wrong. What it tells you is offshore is going to stay relatively flat percentage-wise from 2018 to 2025. Whereas unconventional is going to rise from 12% to 20%. We all know, I've shared a lot of data on shale and why I think unconventional is not going to be this sort of growth trajectory that they're saying. So now there's a double whammy. One is because the global production is going up in general, the percentage staying the same leads to a higher number of barrels being produced offshore on an absolute basis, but also if shale actually can't do this, which is what they're projecting, shale and oil sands to grow, what is it, looks like 3 or 4 million barrels by 2025. I don't think that's realistic. So who has to take it? Well, somebody else. It's not going to be conventional onshore, which is in this flat to declining wedge at this point. It is going to be your offshore fields that have to come up and be that call on demand, call on supply option. Can they do it? We'll see. One of the big interesting points that makes our macro thesis so strong is that if it is offshore or the oil sands that have to bring up this production, it's not going to happen overnight. There is a gap, there's a void in the market, not just an exploration void, but a development void and a financial void that has to be filled before these barrels can come online multiple years down the road. So something really for anybody that's looking to overall understand the macro thesis, there's those two parts to it, is that even if we have the right amount of exploration and development and money coming in, there's a few years where we can rake in those profits, and 4, 5, 6 years down the road, demand might continue to rise, and we may never meet our requirements as to what we need at a lower oil price. So the oil price has to be higher in order to bring those fields online, which are going to meet the growing demand. So another very clean chart. This is from Rystad. A lot of this presentation is going to be from Rystad, just given they have really good details on this. I don't like their forecasting, but the data collection they have is really, really good. Here is the same chart for oil and natural gas. So you see, when we look at offshore production, shallow water flat to declining. We see our deep water starting to increase. This chart only goes till 2016. And then natural gas. We're seeing in natural gas, it's the opposite, where shallow water is still increasing because we still have a lot of very prolific fields, which we'll discuss here as the presentation goes on, that are offshore shallow water gas. At the same time, the deep water also continues to pick up, because if you're drilling somewhere, you're going to put on an FPSO anyway, and there's this massive gas field next to it. Maybe you say, okay, let's target both developments at the same time. And also, when we look at places like the North Sea, their shallow water gas is getting lower and lower now. So they need to just geologically go into the deeper water. I unfortunately don't know what the depth difference is between shallow and deep water. Like right off the top of my head, I think there's multiple different categories. Actually, it's not just shallow and then deep. There's also the ultra deep water and other naming conventions. But for the sake of the presentation, shallow water is going to be easier and cheaper. Deep water is going to be your more expensive, further out, call it 50, 80, 100 kilometers offshore platforms and development. This is a 2015 chart. I went back a little bit just to give you an idea of where the appetite was for exploration and drilling in 2015. We see the Gulf of Mexico is by far the leader here in terms of offshore oil rigs. The North Sea, of course, is going to be number 2. And then we have your Far East Asia, Malaysia, Vietnam, the Thailand fields that are going to be your 3rd and 4th, and then the Persian Gulf. So we're talking about Saudi Arabia, UAE, Iran, Kuwait, these sorts of countries in that area. Mexico, which used to be a major player at the time, a lot less so now. Some of the governance issues around Pemex, which we will also discuss. And then you have your Brazil and Western Africa closing that out. The rest are your smaller fields, South Asia, Venezuela, we got Russia in there, the Mediterranean, as well as Australia and Canada, which used to be a pretty small player. It still is a pretty small player, but there are some interesting developments that have now come online and are being worked on as we speak. So one thing to notice about the Gulf of Mexico and other offshore basins, they are not quite your onshore conventional decline rates. They are nowhere close to your oil sands production in terms of their stability and their decline rates. Offshore still declines about 60% in the first 3 years. So 3 to 4 years, your production is going to be down about 60%. Not quite the shale decline, which is 80% in the first year, but you're still seeing pretty significant declines in these offshore platforms. So we call them low decline, but compared to onshore conventional and compared to the oil sands, they are still a relatively high percentage of decline in the first 3 years. And then they kind of even out as they go on, about an 80% decline rate in the first 8 years, if you want to take it that way. The one basin that doesn't behave the same way is your pre-salt Santos in Brazil. And this is why people are very excited about the prospect of what Petrobras is doing. They're very excited about Brazilian oil production in general, is because they have a relatively shallower decline rate, which means they're able to get their production rates much higher as they bring production online throughout the decade. So we'll talk about all these much more in detail, but you can just see here, we have shale, we have Gulf of Mexico, we have onshore Alaska, we have our, we have our Campos Basin, which is your post-salt basin in Brazil. You have your onshore Alaska conventional, and then you have your pre-salt Santos as well. And the decline rates between each, you can see why some are better for global base production worldwide than the other ones. The more we go into deeper offshore, the more we go into shale, the more barrels we need to make up every year before we can add incremental global oil production. Global energy spend. So when we look at upstream CapEx, from 2016 to 2020, about $2 trillion was upstream. In the next 5 years, it's going to be just over $2 trillion. And by 2026 to 2030, The projection is for over $2.5 trillion. So about $500 billion a year is going into upstream CapEx. More and more of this is going to start trickling down into the offshore industry. If they are going to be the exploration area, if they're going to be the production area, more money has to start flowing that way. And the reason I have this chart up here is just to show people the scale of sort of what is required just to keep the world running as is. So along with upstream CapEx, we have about $2 trillion in transmission and distribution over a 5-year period. We have our non-hydro renewables, which are jacking up, and then downstream CapEx, which is severely lacking when it needs to really be going up in terms of refining, petrochemicals, and other processing facilities, along with all the other things here. So that is your money at stake here over the next 10 years, call it about $5 trillion in upstream CapEx. And even that may not be enough to meet what we need to get the market back under balance. Project sanctioning status offshore. So we have offshore projects in the range of, call it 75 to 100 billion that was sanctioned. 2020 was our low year, 50 billion. 2021 was a rebound, 75. 2022 was about 100 billion. And 2023 is now expected to drop. And this is one of the issues that I had discussed earlier with what the Biden administration has done with the SPR. Have they been successful at bringing the price down? Sure. Have they also screwed up the investment cycle yet again and postponed it? Yes. And we're seeing that so far. Very few offshore sanctions in 2023 so far. Onshore is a little bit better, but still, when we look at what we've sanctioned so far, it's a paltry amount compared to what we need and compared to what was the norm in 2018, 2019. And let's not even talk about where we were in 2010 to 2014 or 2014 to 2016 when things were really getting sanctioned and money was being spent on these long lead projects to come online 4, 5, 6, 7 years down the road. Project commitment by water depth. So what we're seeing is the onshore LNG is your major market at the time. I mean, people who are active in the market will realize that there has been a number of major onshore LNG terminal announcements so far this year, especially a lot in the last month or so. We look at onshore, nothing much going on here. And then your ultra deep water is really what's rising a lot. When you compare it to the previous years, your ultra deep water investment is rising a lot. So I would like to make kind of a caveat here. When people talk about deep water and they say our company has this much deep water potential, or they have this much offshore potential, or we're talking about service industry, we have this many drill ships and whatnot, make sure to look into what rating of drill ship they are, what rating of prospect they are, because the money more and more is going a certain way, and your production is going to come more and more from a certain depth of offshore rather than just bunching offshore into one basket and just leaving it there. So pretty interesting chart. We'll see how accurate this is as the years go on. They are betting on a big rebound in onshore project commitments in 2024. Could that be oil sands? Could that be other shale plays? We don't entirely know yet, but we'll kind of watch this going forward. When it comes to Europe, a self-inflicted calamity. They have spent more on offshore wind in 2022 by about 30 or 40% than they did in offshore upstream oil and gas. So I have no sympathy for the governments and the politicians that continue to misallocate their resources. Not saying that offshore wind is bad, but when we talk about return on investment, when we talk about energy security, you need investments in offshore upstream oil and gas, and Europe just does not have their head in the right place, and they are paying the price accordingly. Global offshore wind itself is becoming a major factor. So I know this presentation is more offshore oil and gas focused, but when you talk about how come we're not seeing the investments in offshore oil and gas that maybe we should in a bull market, because there's other offshore that's taking up some of the spend that used to be taken up, and there's only a limited number of expertise out there. You don't have millions of deep sea divers and undersea cable manufacturers and everything else. There's a limit to that And if it's being taken up by other industries, that means there's less to go for oil, which in a sense is better for our structural undersupply argument and thesis. This is another thing that Rystad puts out. It's a major projects likely to be sanctioned in 2023. So they kind of give you a global understanding of which projects are going to be sanctioned. Are they already sanctioned? And what are they? Are they a gas? Are they oil? Are they LNG? So we have some interesting ones in the US Gulf of Mexico, LNG. We have some drilling offshore China. We have, of course, our Angola, Nigerian area. We have our Persian Gulf. We have the North Sea up here. We have Brazil and Guyana and Australia. So you kind of have everything covered here. We will discuss all of these, not the projects, but the areas here going forward. We also have this majors exploration drilling. So this report comes out every month. And again, this session is more informational. So I'm sharing the things that I get and am able to disseminate. We see information on all 6 majors. So we have BP, Chevron, Eni, Exxon, Shell, and Total, and what they're doing every single month. So what kind of success have they had? What is their future activities? What is their development plans? And where have they acquired acreage? So some pretty interesting things happening. We see BP is doing some activities in the Gulf of Mexico and in Canada. Chevron is not doing much. They've kind of lost out on Guyana to ExxonMobil. Eni focused on Africa and your Indonesian, Malaysian, Thai acreage. Exxon, of course, they have their baby Guyana. That's who they're going to feed. At this point, Shell is active in Namibia. They're active in Brazil and then in some other areas. And the Total is also in Namibia, where they hit the Venus discovery, which could be pretty interesting how that pans out. And I believe they're also in Suriname. So don't quote me on that, but it is nice to see the majors putting some money into this as a petroleum overall development standpoint, but nothing too crazy. They're not going all the way out and just going crazy. The shareholders don't want it. The investors don't want it. Management has no reason to take on risk to their own jobs by going and doing all these activities on top of the bare minimum / development, basic development potential. So pretty interesting stuff going on. Like I said before, it's the majors that are really going to have to carry the lead here. They're the ones that have the excess money to do these projects, and they can afford to develop them, whereas the smaller producers can only be either a small percentage or a delineator, but it takes them a lot longer to do what the majors can do in a shorter period of time. Here's the same table, just in a map fashion. So gives you a little bit more understanding of where the different companies are active. We see, of course, your major areas. Once again, there's only a few major offshore areas. It's not like onshore oil, where you have plenty of fields all around. Even though offshore, of course, covers the majority of the world, given that water is the majority of the world, there's only so many areas that are economically feasible at this point to go and explore and then develop. And a lot of them, shallow waters, have already been developed. So we're now getting into the deeper and deeper waters, which lead to a technical limitation as to the stresses and the forces that the drill rigs and the pipes and the platforms can take, which is being worked on, but it's still a technical, physical limit according to science. So how are the majors doing? I guess we should ask ourselves if they're the ones that are going to be investing in offshore and deep water. Their FCF per BOE is the highest in 2022 than it was since 2010. And by a large margin, about 10 to 20% higher than it's ever been, even in the glory years of 2010 to 2014. Their investment ratio is down to 25%. So they're obviously making money, they just are not investing it. Their investment ratio is at a record low. Just for comparison, in 2010 to 2014, the investment ratio was between 60 to 90%. In 2015, it got as high as 110%. And now it's down to 25%. So there's no appetite for excess risk taking on, for excess drilling, excess exploration. Despite the fact the world needs it, the companies have no incentive to do so, especially when they get bashed on over and over and over as to their emissions and their constant lack of respect for the environment and everything else that goes on with those sorts of discussions. What about their long-term debt? Well, looking really good. The long-term debt is back to levels it was pre-COVID. The short-term debt is down even lower. And the cash and cash equivalents that companies are sitting on right now is double that they did back in 2019. So they had about $80 billion of cash on the books in 2019. They now have $160 to $180 billion of cash on the books in 2022. So it's not a debt pay down problem either. They've paid down the debt. They have a lot of cash on the books. If they choose to explore, they could. But once again, there's no incentive to do so. At this point in time, there's no reason. The multiples are not high enough to justify the exploration success anyway at this point in time. Net debt to equity ratios are down to historic lows. Once again, about half as to what they were in 2019. That's a direct relation to the cash piling up on the books and the debt coming down for these companies. Share buybacks, the highest we've seen by a large factor in 2022. We saw buybacks, I call it 3 to 4 times that we did in 2019. So the companies are in good shape. They are doing really well. So from an investment standpoint, we see why ExxonMobil is hitting all-time highs in terms of their equity price. We see why they're doing so well, along with some of the exploration and development they've done. Their balance sheet and company itself is in really, really strong hands. They're not worried about low oil pricing. They're not worried about hedging requirements. They're not worried about these things when the debt to equity ratios are much more manageable. At the same time, as a supply-focused cycle investor, you have to realize the companies that can explore and develop have the cash. They don't have debt. They're buying back shares. They're paying dividends, which means if the cycle turns somehow where prices skyrocket and they stay there for an extended period of time, the companies have the money. They don't need the banks. They don't need any hedge funds. They don't need any alumni networks. They don't need the support of any governments or subsidies. They have the cash to do it themselves. So one of the voids in the market, which is the financial void, may not be a real concern for the majors and for offshore development. So this is why I wanted to do this presentation. One of the reasons is really, as an investor, you should be watching offshore discoveries and any major developments that are going on, because they are a major headwind to our supply thesis. So far, anything concerning? Not really. There's not the level of activity that we need, nor is it happening as fast as we need to get the oil online within a 5-year period. So far it's good, but something I track very often because it is one of the major issues that could play against our multi-year bull thesis. Top companies in terms of what they did last year: exploration spending. Shell, by far the most. They spent about $2 billion in exploration last year. Exxon, about $1 billion. And then the rest are sub-$1 billion. Exxon, of course, the most successful with their Guyana acreage. They have it largely delineated. They know what they're doing there. They are going to have the highest success rate. Shell, on the other hand, brutal. They had 29 wildcat wells. They did not find very much at all. Their finding cost per BOE is about 3 to 5 times their major competitors. So spending the money, not finding what they're looking for. This is going to be a trend going forward in this discussion, is that deep water exploration and wildcatting is not a high success rate at all. We'll share some more data here as time goes on, but you can see how much money was spent versus how many resources were discovered. This includes both oil and gas, so just be careful with the BOE metric. But at the same time, you can see which companies or national state-owned enterprises were able to be more successful, which ones didn't really hit anything despite spending a lot more money. Shell and Chevron, of course, at the top of this list there. why is Equinor not on the list? So I actually don't know why Equinor is not on the list. It could be possible they're showing up under Aker BP or under some of the other entities that own, possibly Equinor is the driller of the project, but the pool itself is owned 35% by Qatar or owned by somebody else. But Equinor is discussed later on here, so we will be sure to mention that. Here is the same graph, but more, or the same table, but more graphically. So we have Exxon, the high success rate. We got some of the other ones where the value creation was not as good for the amount of dollars that they put into the ground. And where was this exploration done? Well, when we look at exploration wells by continent, we're moving more and more towards South America. We're moving towards Africa. We're moving away from the developed areas like Asia, Europe with the North Sea and the Gulf of Mexico. We're moving more into these frontiers for exploration. And when we look at where the wells were drilled, we see the same thing by continent and then by company, by continent as well for 2022. A lot of activity in South America and then Africa as well, although a little bit subdued in 2022 by Exxon and Eni. Exploration wells by water depth, you can see how deep water is picking up materially. Our ultra deep water also is picking up materially. And this graph, the majors are focused on offshore. You can see how all of them, except BP, increased their offshore exploration well count, and they reduced the onshore exploration well count. So a changing trend as to where these countries or these companies are moving their investment dollars to. Always watch the trends. The trends change slowly, but then as they compound on each other, they become much larger and larger trends going forward. What did they find? Exxon found mostly oil, Guyana, Total 50-50, Eni found mostly gas, Chevron also found mostly gas. And what did they find? Exxon found Guyana, which is a mature field. Mature in this context means that the oil is ready to go and be produced. There's other fields that are immature fields, meaning that although there's a working petroleum system, there's oil there, it is not your conventional, easy to produce oil. You might have to do some other work here in order to bring it online, or the oil is just not mature enough yet to be produced. That's it. So you have the system, you have everything, but you can't produce the oil just given the system has not reached its right temperature, its right age, or its right pressure yet in order to create a movable, mobile oil system. We also have it by continent, and then once again, by water depth. So the fact that Exxon discovered Guyana in deep water, not ultra deep water, is definitely skewing the numbers a bit, just given that that is one of the major discoveries that has been found in the last decade or so. So it does skew some of the numbers and investments just by nature of how big and prospective that discovery is. Exploration spending by continent, you once again see ultra deep water is where a lot of the money is going. And then you have deep water, and then the shelf and land are basically zeroed out at this point. And again, by continent on a what do you call these spider graphs? We also have up and coming major wells to watch. So for anybody that said, hey, maybe I should be tracking these majors and their successes and developments a little bit more. Here you go. Here is the chart you need. We have the wellbore name, we have the country and the continent, what is the asset name, and then the company doing the drilling. These are all offshore. Some are planned, some are in progress, but you can actually track it well by well as to where things are going, and then make your own interpretation as to, hey, okay, they discovered X amount of millions of barrels of resource in this block. Is it a successful discovery? Are they going to now FID it? And if they do FID it, how long is it going to take for that oil to come online? And what is the expected production profile of that? And if people are willing to do that kind of work, you will know as soon as there's a problem on the global supply demand in terms of the undersupply bull thesis. because you will see when you add up all the graphs together, there will be certain years or certain months where that big gush of supply is coming online. And that will maybe, for people that ask me, what is your exit strategy with oil and gas investments? You have to put in the work in order to make your own interpretation as to what that timeline looks like, given that the information is already there. All you have to do is now look into it deeper and create a context and a analysis of that moving forward. Summary of exploration. So we have mostly offshore and frontier. Once again, every graph is proving the same thing, that this is the future of global oil supply moving forward. Other than, of course, the Canadian oil sands, which remain the gem, untapped gem still of North America. The rest of the world is really moving towards offshore. We have acreage more split by continent and then by maturity. And once again, this presentation will be online on the website. So anybody that is wanting to really dive deep into any of these tables and graphs, you can have a look at this after the presentation. It will be posted on the bottom in the files section of the website. Now let's look at the NOCs and the IOCs. So the national oil companies and the international oil companies. We looked at the majors, the publicly held majors. When we look at the state-owned enterprises, CNOOC is really the one doing a lot of the work. They have discovered a lot of liquids. We have Qatar Energy, Petrobras, Petronas, Petramina or Pertamina, and other Asian producers. We have Equinor. You can see why maybe they didn't end up on the list earlier. Absolutely catastrophic exploration success. Not good at all. By maturity, once again, by continent, CNOOC is involved in South America as a working partner. Petrobras, obviously in Brazil. Qatar Energy is going to be also a silent partner in a lot of these projects that are all across the world. By water depth, once again, we see certain companies are focused on your ultra deep water. Other companies are a mix of shelf, deep water, and then your ultra deep water. But the trend, as we showed earlier, is moving more and more and more towards deeper and deeper waters, which are more expensive, which potentially contain bigger discoveries, but also are much, much, much harder to produce, given how far offshore they end up being. And for the NOCs and the IOCs, the exact same graph, we see a trend towards offshore. In fact, in 2021, they had 0 onshore awards for acreage. So a changing trend that is accelerating going forward. Also pretty interesting that a lot of immature fields are being found now, given some of the exploration going on in India, China, and in the North Sea is targeting some of these fields that may have been not targeted before or skipped out because there may have been some data that shows there could be oil here, but you're not going to be able to produce it. So money, this all costs money. This is not free. It all costs money. Every exploration success has a real cost. It has an opportunity cost going forward as to the company's prospects and their top line revenue and the bottom line profits. Wells to watch on international oil companies and national oil companies. So the same exact table that was provided for the public companies is now here for the other companies, the state-owned companies. So all you got to do is track these 15 wells, track the 15 wells on the previous table, and you will have a pretty good idea as to how offshore is doing, both in exploration and its future potential down the road, call it 3, 5, 7, 10 years down the road, because you need exploration success before you can do any sort of development or production operations. Okay. Projected exploration CapEx for 2023 now by these NOCs and IOCs. We see some major numbers here. Up to $3 billion for CNOOC. Equinor is at about 1.2 billion. Where are they drilling? They like to be in their local areas a lot, supporting the countries that's supporting them. But at the same time, they go and buy stakes in other companies as well, which allows them to participate in success. You see up here, Qatar Energy is 25, 30%. We see Petronas 27%. We see Equinor 35%. So they like to mix in with 3 or 4 other companies or 2 or 3 other companies, de-risk the project so that when they find something, they can participate, but also they're not out there drilling their own dry holes everywhere, which is not a good business plan for any company, let alone the national oil companies, which rely on this income for their internal budgets. And here's one more map on Qatar Energy and what they're doing here. Egypt, Guyana, Mexico, Namibia, they are involved in various places in the world at this point. Equinor as well, obviously active in the North Sea, but they're also active in Canada, Suriname, Brazil, Argentina, the Gulf of Mexico. So when you're looking at offshore companies, they rarely go and do a development or exploration on their own. There is a lot of partnerships that are taken on. There's a lot of de-risking that happens. There's a lot of farm-ins that happen, which allow more companies to participate and also de-risk the project for the owner. So always keep this in mind. When people keep talking about ExxonMobil and Guyana, Hess owns a large portion of that Guyana development. So just keep things in mind. It's not 1 million barrels for Exxon by 2027. It's 1 million barrels for Guyana by 2027, of which Hess is a partner with Exxon in that. Okay, this is a pretty interesting graph. So number of minor discoveries found in the world offshore. In the 1980s, 1990s, a lot of the discoveries found were major discoveries, above 75 million BOE discoveries. And now, since the turn of the century here, we're seeing more and more of these minor discoveries being found. Double impact to this. The first one is you're spending the same CapEx in order to drill a well, finding a major discovery or a minor discovery. So from a per barrel in the ground economic standpoint, things are deteriorating. Yes. The other thing is some of these discoveries may never be produced. If you have an offshore discovery making 25 million barrels of oil that can be recovered, does it make sense to put up $1 billion platform in order to produce 25 million barrels? Not at $60 or $80 oil, at $300 oil, sure, but not where we are today. So we once again keep coming back to the same point that today's oil price is not sufficient to allow the companies to explore and develop the supply of oil that we're going to need as the decade here continues. Here are the identified basins with infrastructure potential. So they already have infrastructure in place that somebody can come in, do a discovery, and produce it, even if it's a small discovery, smaller discovery. At the same time, they are ones that are open to development. So we will be discussing these major players. We have Gulf of Mexico, we have the North Sea, the Angola, Nigeria area, offshore Brazil, we have the Persian Gulf, the Mediterranean, Australia, and then our Asian platform. Of course, there's China, Russia, all that on top of that, but these are the major platforms that already have infrastructure that are ready for development should the right investor come in and be able to finance it and find the oil and then produce it. Acreage and where the licensing is coming up. So for somebody who wants to dive in even deeper to this, you don't just want to track wells, you also want to track the acreage sales and where they're happening. Here you go. You have a major sale coming up in the Malaysia area. You have major sales coming up in Suriname, as well as a little bit in the Gulf of Mexico as well, I believe has now restarted. And how much acreage is open and how much acreage is licensed, which tells you a rough estimation of how much of the acreage is currently under engineering, under geology, and being actively worked on. It also gives you the largest stakeholder by project. So certain areas, if you have smaller companies that are the major stakeholder, they can only produce so much. They can only CapEx so much. Whereas areas like Malaysia and Thailand that are controlled by Petronas, Shell, these kinds of corporations, they have more money that, hey, if we do find something, we can go and really accelerate development in order to bring a large quantity of barrels online. So it all comes down to the data is already there. If you want to have a really, really good grasp on supply, all you got to do is look into it and figure out what are the major blind spots, what are the major players that can really increase production. I'm not talking about a 5,000 barrel per day well. We're talking a 500,000 barrel per day development that can happen over a 5 to 10 year period, because those are really the ones to watch. And if more and more of them fail to explore anything, if more and more of them fail to get FID in order to bring production online, the cycle is going to be longer. There is no two ways around it. That is the reality of the oil and gas market that we live in at a time that the world continues to consume more and more oil every single year. We also look at spare capacity. So I talked about areas with infrastructure in place. Where are the areas with spare capacity? Here you go. If a discovery is made in these areas, we have upwards of 3 to 4 million barrels per day of extra capacity that could be brought online because the infrastructure is already there. Why is this? These fields used to produce these amounts of barrels in the 1970s and 80s and 90s and in the 2000s. Now they're declining, so they have extra spare capacity, and then the spare capacity per hub within these areas as well. So I think this is a good time to just say, for anybody that's maybe a little bit confused and you would like to join for the Zoom visuals, whitetundra.ca. If you scroll to the bottom under events, the Zoom link is in there, and the tables may help you a lot with the tables and charts may help you a lot in understanding what is being discussed. If not, if you're just driving or whatever else and you want to listen in, the spaces will continue running as well. So yeah, we will keep going here. Yeah, I will be talking about Canada specifically here as we go on. Here's the average government take. So when you look at these projects and you say, hey, something has been discovered, we now have spare infrastructure. Now you got to ask, is it economic? There are certain countries in the world that take a lot of government take. So I will mention one here in specific, this Viking Graben. It has the highest spare capacity of any area in the world for offshore development. It also has a 78 to 80% government take, which means of the profits that are being made, the government is going to take 78% of that. Let's look to the left of this graph. Campos in Brazil, 35%. US Gulf Deepwater, 40%. There is an extensive economic analysis that is being done before offshore projects go ahead. If oil prices are going to be higher for a longer period of time, do some of these projects on the right start making sense? Possibly. 20% profits on $120 oil still looks good. 20% profits on $67 oil doesn't look all that great in terms of the risk you're taking on to develop these. And keep in mind, exploration money was already spent to find these resources. They're not free. If you develop them today at a lower oil price, you will not get the benefits of having that resource or reserve at a higher oil price. So there's a real physical constraint that happens here. I believe Guyana is somewhere in the 50 to 60% range. Don't believe it's on this map or on this chart specifically, but I want to say 50 to 60% range is where Guyana is. So somewhere in your African, Arabian, general Asian market competitiveness. CO2 per BOE. Why is this important? Because investors are going to be looking at this. If the majors are the ones that are exploring deep water and offshore, they have to be worried about their ESG report and their emissions, scope 1, scope 2, their flaring intensity, their venting intensity, and the CO2 storage potential. The US Gulf Deepwater is by far the best of both worlds. It is your lowest emission asset that also has the highest CO2 storage potential. could be a nice little case for them to get a lot of funding here going forward, as well as some acceleration for development, given that it's a lower emission area, which the majors want, rather than some of the higher emission areas, which screws up their ESG profile in terms of just the raw numbers. I'm not going to make a case as to whether it's good or bad, or people should be focused on this or not. The majors are focused on this. The investors in the majors are focused on this. And therefore, it is something to take into account when you look at investing in some of these companies going forward. And this graph also shows the higher emission ones with very low storage potential as well. Offshore investments. So this is 2023. Where are they going? The Middle East, South America, Western Europe, North America, West Africa, and so forth. The Middle East is really ramping up their offshore capex. Saudi Arabia in particular is ramping up a lot, and I will share more on all of these things. We're still in the intro part of the presentation, so just be patient here with kind of the rest of the information that's coming. We will discuss all of these countries and areas. This just tells you where the money is going and who is likely to benefit from the production gains from that investment. We also see, what chart is this? So the same chart, but split by operator. So who is spending the money in 2023 in offshore? Aramco is spending $15+ billion in just offshore developments, or offshore investments in 2023, and ramping up materially. Petrobras as well, two major players to watch going forward, given that a lot of their economy runs through oil revenues. So they have a big incentive to go and explore and then develop these projects going forward. Also, what is the money being spent on? You can see seismic, engineering, procurement, subsea, topside, rigs, drilling tools, all kinds of things. Maybe there's a case to be made here that it's not just the offshore drillers that are going to make money. Perhaps you can see something else in here where the wedge and the absolute number is growing larger moving forward. Middle East offshore rigs. I just mentioned Saudi Arabia. You can see how they're adding about 30 to 40 rigs in 2023. Same with what they've done in the past. They have been one of the major leaders. This year, it's out of the park, completely out of the park, and taking a really big stake here going forward as to what they want to do in terms of offshore. They have some very interesting offshore fields. Again, they will be discussed later on in the presentation. And, they are really taking this by the throat here. They said, hey, we need to make sure that if OPEC wants to be the ones that dictate what happens on the global market, we need the supply. So they're putting in the investment. Is it going to work out for them? We'll see. We'll see if they can develop and explore everything to what they say they can in the right amount of time. FPSO awards by area. So 2023, Brazil, Guyana, Angola, the UK. About 12 FPSOs got FID'd, awarded. We have another 12 more, but these aren't going to come online until 2026, 2027, 2028. So there's a large gap here that still has to be met. You can see the previous few years, very little non-Brazilian development that happened, non-Brazilian, non-Guyanese development that's happened in the previous 5 years, which means in the next 3 or 4 years, very little oil is coming online from non-Brazilian, non-Guyanese sources going forward. Global wildcats drilled per year. So the number of wildcats drilled here on the left, mostly onshore, some offshore. Look at the success rates. The offshore success rate for global wildcat is down to 15%. The onshore rate is down from about 60% in 2015, 16, 17 to about 25% in 2022. It is getting harder to find oil. Don't let anyone convince you that just because we have the money or just because the politicians will push companies to do so, they can go out there and at the flick of a button go and just discover oil and go and produce oil. It's not that easy. There are literally hundreds of thousands of people that work every single day to try and find oil. Can it all be produced? Like, let me rephrase the question. Do we have enough oil in a $300, $400, $500 per day oil market? Sure. Do we have enough oil for a sub $100 per day oil or $100 per barrel oil market? No. And that's really why this cycle is going to be a very interesting cycle, a geologic cycle that relies on us continuing to hit at least 15% success rates. Maybe this number continues to drop. As we go deeper and more offshore, maybe the success rate drops. Maybe the discoveries are not commercial. Maybe they're not the right size in order to be produced. So this is a real fundamental science question that we are facing. This is not a video game. I keep saying the same thing, but this is not a video game where we have infinite pools of oil and at the right kind of funding environment, we just go and drill wells. There's a real physical delay and there's a real physical financial impact of these lower success rates moving forward. Successful wildcats, a lot of them are gas, the ones that they did discover. And of those, 40% are uncommercial. So even though the wildcat was successful, now take that 15% success rate and take into account that most of them were gas or liquids plus gas. The pure liquids ones are maybe 30%. And then of those, only 60% are commercial. The other 40% are non-commercial. You can see why this is a game for the big boys only, and also why we are getting into a oil environment where we have now produced and consumed the easy oil and the medium oil. We're now into the hard oil and trying to discover and delineate and produce that. Yeah, wildcat well just means that there is no close well nearby that has any oil kind of discovery. So you're drilling somewhere where it's pure geology, geophysics, and engineering, and you're just going and trying to find oil away from any known discovery. Well, let's talk about the unsuccessful wildcats. Some of these were estimated to be more than 1 billion barrels BOE to be found. Dry wells, very slight shows of oil and gas, or unable to be produced. We lost a lot of barrels last year to unsuccessful wildcats, including some major fields in new areas, Australia, Bangladesh. There was a offshore failure in the US offshore, as well as the Guyana, which was a very recent failure in South Africa, very highly touted prospect by Eco Atlantic. That was a failure. Some other ones in the Norwegian North Sea area that didn't work out. So guess what? It's actually pretty easy to follow offshore. If you're willing to just put in a little bit of work to try and understand what are the major wells, what are the major companies, what are the major areas, what are they drilling, and when are they going to produce it, you now not only, you don't have to follow these things well by well by well. Every single year, we get this list that tells you which ones were successful, which ones were unsuccessful. If you want to care more and invest in these companies, or you really want a month-to-month analysis as to what's happening, you can also do that on your own. These well results are publicly published. Whenever they are, they will be on OGJ.com. The Oil and Gas Journal reports almost every wildcat drill and what they produced, how long they produced for, is it commercial, was it dry, what resource they found, et cetera, et cetera. Okay, and what did they find? Well, you see these tiny little resources, 30 million BOE. That is not a commercial field. If you have a 30 million BOE resource, you have 12 million BOE recoverable. That's nowhere close enough in order to do any sort of really high impact development. We see some developed, some resources found 100 to 300 MMBOE, some found up to 1 billion BOE. Nothing above 1 billion BOE was found last year. So let me put this in context. The world consumes 36.5 billion barrels of oil every single year. The world consumes about 60 billion BOE of oil and gas every single year. We did not find a single discovery over 1 billion BOE resource, let alone reserve, last year. You can see why the scale of the problem is so large moving forward, once again, in a world that continues to consume more and more oil moving forward. Evolution, as I said, watch the trend. We're moving more and more towards deep water in terms of resource, greenfield, and number of projects. Here is our offshore wells by EUR. So you can see some of the more prolific wells are in the Gulf of Mexico, the Persian Gulf, offshore Angola, Nigeria, and Brazil, Guyana as well. Some of the wells that are in the Asian areas are much smaller, 5 to 10 million BOE EUR. Same with the North Sea. It's an old, tired acreage. Your wells are going to be smaller just by the nature of what the easiest and most profitable oil is produced first. So one to watch if you're looking at investments in the sector, you want bigger wells. It clearly tells you where the big wells are and where the small wells are. This is Sakhalin Island, Russia, if I'm not mistaken. So some major discoveries there as well in the last few years. The average EUR per well in expected ultimate recovery per well. The wells in Guyana are making 75 million BOE each as far as the projected EURs. Insane, absolutely insane. So why is the deep water low success rate and the wildcatting and the exploration worth it? Because of exactly this. When one well can produce 75 million BOE, that is going to make you very, very rich with just one discovery, let alone what Exxon has found in Guyana, which is multiple of these discoveries. And you can see the same going downwards. You can also see why Guyana is not going to be repeated. Where all the people saying Suriname is the new Guyana and Namibia is the new Guyana, you would be very lucky to find anything close to a Guyana going forward. This is a historic discovery that came on at a very good time. It also came on to an operator that could afford to develop it and had the technical expertise for it. So let's not go around making claims, these sorts of claims, until something is actually discovered and then actually produced, because nothing else has ever even come close to this in history. Average EUR per gas well. We see Israel has way, way, way better gas wells than the rest of the world. We also see Argentina, Russia, of course, a big major gas player, the Philippines, Turkmenistan, Iran, all these areas. You can just kind of compare these depending on what you want to see. No real particular insight I have here as to why one is better than the other in terms of global gas production. Yes, offshore can do water flooding. They can do exactly what onshore can do. There's nothing stopping them from doing anything. It's just more expensive and it's more risky, given the fact that a lot of these pipes are sitting in salt water. You have the constant force, you have hurricanes, you have earthquakes, you have larger volumes, and everything's just more expensive to begin with in terms of safety and engineering and construction. Do you have insight as to the deep water wellhead pre-ordered? I actually don't. I don't track deep water wellheads pre-ordering. I track the service sector money flow on an overall basis and then by product or by subsector per se, which gives you an understanding of the money being spent on all of these things. But you are right. If somebody wants to track the steel or the wellheads, you can even know before the commitments are made. I just don't think it's important enough for my supply thesis. when the wellhead is ordered is so far earlier than when the production is going to be online, it doesn't make a difference whether I track wellheads or whether I track the actual FIDs or FPSOs sanctions. Yeah, for sure. There are many areas I'll talk about as the presentation continues that are areas to watch out for, including Suriname and Brazil and Norway and everything else. But the reality is there is only, as we speak, one Guyana. And let's not take other areas and say, this can be 1 million barrels per day in 6 years. It could, we'll see. So far, the results are not that great out of Suriname. A lot of condensate-rich oil rather than pure oil, and then some recoverable quantities that are being revised down by Apache and Total as well. And again, this is not a personal comment at anyone. I'm just making a general observation. We are unnecessarily bullish when it comes to one discovery somewhere and then using it as a proxy for elsewhere. They are all different depositional environments, although there are similarities as well. The Guyana new oil has pretty much a zero decline at this point. I don't think you can think about the Guyana FPSOs as a declining asset because what they will do is, as the wells decline, they will drill more wells in order to keep their FPSO floating production and storage platform online at its maximum capacity. So you can basically at this point think of it as a zero decline asset moving forward until at least for the next 2 or 3 or 4 years while the FPSOs are coming online. Average well CapEx per BOE. So where is it more expensive to produce gas? Where is it more expensive to produce oil? When you look at Asia, we look at North Sea, we look at Angola, Nigeria. Why has production started to flatline or drop? Because it's expensive. The offshore CapEx is a lot compared to Brazil or UAE or Saudi. When we look at gas, same thing. Why does Thailand or the UK not produce a whole ton of gas? Because it costs a lot more compared to Iran, which is about 1/15 the cost as a similar BOE of gas being produced in Thailand. So naturally, economics take over, business takes over. The countries with a lower supply cost are going to be the major players. Of course, Iran and Qatar have the South Pars North Dome field, which we'll discuss, absolutely prolific. So it's impossible to compete with those sorts of economics. Offshore production, I talked about trends. Look what happened in Brazil in 2015. From 2005 to 2015, this trend has just continued exactly with ultra deep taking over. US, Angola, Norway. Norway has always been a deeper water production because a lot of their shelf is offshore, very offshore to begin with. And then here you have the rest of the world as well. So the trends do end up becoming true as sort of time goes on. I mean, Saudi. So there's a question here. Declines every year. Does new adjustment? Oh, I see. Yeah. I'll talk about Guyana more here as we go on, but adding about 200,000 barrels per year. So you take 6% global decline, you've covered about 3% of that from Guyana, 3 to 4%. And this is a field that is absolutely prolific. Yeah. North Sea, the original offshore developments. Norway and the UK, majority. We have Norwegian oil and gas being shown here. We have the UK oil and gas being shown here. You can see about 6 million BOE in the last decade, roughly flat, but there's a couple major reasons for that are not going to be reproduced anytime soon. When we look at the UK, they used to produce oil and NGL almost 3 million barrels per day in 2000. Today, 600,000, 700,000. There's your 80% decline in 20 years. That's a pretty major number to make up for, and it's going to continue declining. You add on the fact that they just introduced the windfall tax legislations you can say goodbye to any growth here. This is in terminal decline moving forward. That's just the reality of the geology of what they have left. Here is a terminal decline. Not really a good investment thesis here. You're going to find smaller wells. You're going to find possibly non-commercial wells. All the easy acreage has been found, discovered, and produced already and consumed. Natural gas, same problem. They used to produce about 2 million BOEs of natural gas in 2000. Today, less than 500,000 BOEs of natural gas. A continuous problem that they haven't fixed, they haven't addressed, and they continue to take shots at the oil and gas industry rather than support it, when probably be the more prudent thing to do going forward. Norway is on a similar but different path. They had their peak in 2000, then they dropped about 50% till 2015, and now the Johan Sverdrup field, including its phase 2 that just came online, is reinvigorating life into this. Also, a lot of their production has gone into natural gas now. Norway, a big beneficiary of the European 2022 gas crisis, as well as any future revenues from the lack of development in the North Sea. They have really increased their gas production more than about 3x since 2000, really benefiting, focused more on gas and bringing really, really high impact discoveries online, because they realize this is their lifeblood. This is how Norway functions. They have a multi-trillion-dollar fund that was created from the benefits of oil and gas. So the more business friendly, the more grounded in reality of the two countries in the North Sea. The fact that they own all their own oil through Equinor and Lundin Norway and everything else, also obviously a big benefit to continue the gravy train rather than shoot it in the foot like the UK has, which has more privatized producers running the show and more singular producers running the show. The same graph, but a little bit into the future, you can see how the Johan Sverdrup field has really helped Norway. And I will discuss this field in very extreme detail, well, a little bit more detail here as this section continues. However, Norway is not hitting their forecasts. In 2022, they missed the forecasted production every single month. They were below their 2021 production every single month. I will give it to them. The Johan Sverdrup phase 2 didn't come online till late 2022. At the same time, it was never in the forecast. So what's going on? The decline rates are a tiny bit higher than what they were projecting. And you will see this as a consistent theme in future oil and gas developments, is using decline rates and productivity from more productive fields and trying to use a one-to-one correlation to new fields, not going to work. The newer fields have slightly lower permeability. They might have slightly lower porosity. The water saturation might be slightly higher, which means the overall productivity is going to be 2, 3, 4% lower per year, and that compounds over time. So these production metrics that are being put out till 2025, always take them with a grain of salt. I would take off 3 to 5% from them, depending on how far out they are, because, I mean, the data is right in front of you. Every single month, they miss the forecast. Every single month, they miss production. Now, there's a second factor here. Norway uses a lot of gas reinjection offshore. So they'll take the gas, they will reinject it to provide pressure support to their oil fields. This year, they couldn't do that. They had to take out some of these because the gas was selling for such a high premium, and because Europe wanted it, they couldn't gas reinject, and therefore they had not the oil production that they maybe could have had with gas reinjection. At the same time, they missed forecast in Q1 as well. Before any of this happened, they were missing forecast by 2, 3, 4%, 5%. January, February, March. So yeah, there's some explanations for why they missed forecast so greatly in the latter half of the year. There's still a problem here. not a major problem, but 2% of 2 million barrels, 40,000. Take that every single year, take that for the rest of the offshore industry. You can see how it adds up to a major chasm in what people are predicting for future offshore supply and between what actually ends up when the time comes. Here is the offshore map. We have the Troll field, which is a very, very big gas field offshore Norway. We have our oil fields all over. This is the Norwegian shelf. Here is your UK shelf. We have the offshore Netherlands oil and gas fields. Some of the investors in the Canadian oil space might recognize some of these from some of the European countries. Some of the Canadian companies that have European assets that are being shown here. And then we have the new discoveries as well. So the largest liquids producers on the UK shelf are Harbour Energy, BP, Shell, Total, CNOOC. Some of these have publicly come out and said they are not going to invest anymore because of the windfall tax. So there you have it. When the largest producers are saying this, your production is in for decline. Here is your largest fields in the UK continental shelf. Buzzard Field being the biggest one. We have Golden Eagle, which is a Suncor field, if I'm not mistaken. And then, yeah, it actually shows up as CNOOC here, but I think Suncor had a stake here at one point. So anyway, these are the big fields to watch for. And once again, I say the same thing. If you're somebody who's technically oriented or you want to do deeper dives on these things, here are the fields. You can look up the companies, you can look up the fields, you can make a model as to their future expected production, and you can have a pretty good idea as to what future supply demand is going to look like. Very, very, very few people are doing that kind of work. They are just running lines based on some projection that was done off a model. If you put in the work and do this yourself, you can get a very good idea as to why this cycle is going to last many, many, many years going forward, especially given that the supply response is next to zero this cycle compared to last cycles. Here is the exploration and appraisal wells by country in the North Sea. Here is the expenditures, CapEx by country in the North Sea. So you can kind of see Norway is getting the brunt of the exploration and development. The UK is falling behind, not just because of the windfall tax, but also geology, a very poor investment climate, and just a lack of good infrastructure out there. A lot of it is very old, ready to be decommissioned, and nobody wants to take on that liability along with taking over a producing field. Here are the planned developments. So where are they drilling? What are they doing? Which company is doing the drilling? So you can once again see where everything is here. We have the 2022, Norway did something different than what the UK did. They came out and gave tax benefits to companies that would sanction projects in 2022. They had their highest sanctioning year in the last decade. So very nice number of projects approved, number of projects sanctioned. The greenfield CapEx is north of $25 billion is going to be spent. These are the projects. And once again, all you got to do is search up these projects and you will get a technical fact sheet as to when they come online, what the expected peak production is, what the expected production profile is, and you add them all up onto one graph. And you can take this 2025 graph here and stretch it into 2030 or 2035 and get an understanding of where Norway's oil and gas production is going to be at that point in time. Keep in mind, not all of these are oil projects. There are some gas projects as well in here. So for anybody that was maybe getting a bit worried, there is significant gas exposure as well here in this table here. On the other hand, the UK sanctioning was at a decade low in 2022. They only had 2 projects sanctioned. Nothing great, nothing that's an FPSO or anything of a major platform. They are saying there's going to be more in 2023. We'll see. They have not created a very good investment climate for themselves complete lack of energy understanding within that politician governance structure, and one of the most comedic governance structures I think that even exists to begin with. So we'll kind of see how this plays out going forward. North Sea growth is going to primarily come from Norway, is kind of the main point that I want to make here. Denmark is another country, small one. You can see how they had a couple of projects that will come online, but they make such little difference. 20,000 barrels per day, nothing. In a global scheme of things, it's nothing. We as oil investors need to focus on the major players and the major factors. Nobody has time to look at every country and focus on it and their development projects and their production profiles. That's why focus on the main ones that matter, and you can have a really good understanding of global offshore and where things are headed in a relatively short period of time, rather than doing everything to try and understand the problem. Here is our Johan Sverdrup platform. This here produces 750,000 barrels per day. There were a couple of new platforms, I believe, added with the phase 2, but at the same time, this is it. This produces 750,000 barrels per day. Here is where it sits. We have the major discovery next to these 3 existing fields. Green is oil, red is gas. You can see geologically how it's so faulted, which leads to deposition within these bounded reservoirs, let's say. Here is our previous discoveries, the Edward Grieg field, also not a prolific field, but a precursor to the Johan Sverdrup discovery, as well as a field in its own regard. And then we see the massive accumulation of oil that is over here. Really, really nice pool discovered by Lundin, Norway, as I had previously discussed. Very quick development cycle. It was discovered in 2010, 2011, 2012, and it's up to full production in less than 10 years. It goes to show what a nice discovery this was. To find something of this size in the Norway continental shelf is something that's really bizarre, but that's what exploration lets you do. It lets you go into older areas that maybe have been missed. Maybe somebody drilled right here and missed it, and then somebody drilled right to the east here and missed it, southeast, I should say, and then you drill right in the center of this juicy reservoir, and bang, this extent we're talking about. Look at this over here, a hundreds of meters of oil column you have here. Some of the best wells that we've ever seen offshore. Really nice. 10 years is your timeline. We don't have another Johan Sverdrup. When we find one, it's going to be 10 years. If you find one of this kind of quantity and the ease at which this field is able to be discovered and produced, the ease at which this field is able to be produced because of the geologic characteristics that exist in this particular field. When you look at discovered resources in Norway, 2001 to 2012, this is at the time this Johan Sverdrup was discovered. You can see when I say there's only one Johan Sverdrup, there is only one Johan Sverdrup. Everything else is tiny, like just puny compared to what this field was discovered when it was. It by far is bigger than the next 25 or 30 fields combined. That is how good it was, and has saved the world in 2021 and 2022 when it has come online with this huge influx of production. It has saved the North Sea. It has saved Norway and their production profile. Let's go back to the chart. It was in a full decline phase, and now just this one field has reversed it, but we haven't found another one since. We never found one before Johan Sverdrup either. So very good work done here by the Lundin family and their technical staff here who were able to find this. Here is how the seismic looked, the 3D seismic looked initially. You can see, you can't really see the pool here, the geologic unconformities are not able to be seen. It's only when you reprocess the 3D seismic to today's standards that exact pool shows up exactly as it was. So potentially some upside here. If you look at offshore drillers and offshore E&Ps, what do they keep telling you? They keep saying, we have 3D seismic, we have 2D seismic, we got these technical backing saying why we should drill here. Technology has come a long way. Don't take those things as just fluff put into presentations. You can identify real fields when you look at the reprocessed and updated 3D seismic. One could make a case and say, hey, you can see the fault line here as well, right there and right there. And you can kind of see the fault coming down. But no geologist is going to drill a well based on this. You need this to show you the unconformity and the structure, after which you say, bang on, let's go and see what's down there. Maybe you find a non-commercial petroleum system that doesn't move. Maybe you find an immature petroleum system. Maybe you find a degraded petroleum system. They were able to find the best of everything, and kudos to them on this. Very interesting. So there is a comment here made that the Edward Grieg plan and development was dropped last week. So the company that won the license, Aker BP, announced it on March 21st. So just last week, that they're no longer going to develop this Edward Grieg field. That therein goes to show the reality of what a lower oil price has done, and potentially the fact that these fields may not be commercial even at $100 oil. We'll see. Here is a little bit more technical information. You can see how there were wells drilled that missed the prospect. There's wells drilled on the edge of the prospect. And then the 16-2-8 well that went into the creme de la creme and probably had people jumping out of their seats when they saw some of the signatures and results from that. We also have the same thing in a more detailed seismic fashion. So you can see right here, I believe this is a pool, if I'm not mistaken, in here. It's mirrored in certain images, so just be careful with that. But you can see the kind of technical work that's done. I'm gonna by no means claim to be an expert on seismology or geology, but all the information is there that explains to you how these fields were found. Very interesting technical studies and presentations being done. Just awesome stuff. For anybody that enjoys these seminars, you might enjoy some of this other stuff, which is why I like to point it out when the time comes. Here's how productive this field is. It has destroyed even the older BFOET fields, is what we call them, the Brent 40s, etc. fields. The 5. This field is very good. It is right now at just at its peak now, 750, 800,000 barrels per day. There is some talk that the reserve is even better than what they think. Potentially it goes even higher, but it's already in global oil supply. It's already in there. Now we look at where's the next one, because look at the decline on this. Once it's at peak, we get 3 or 4 years of peak, and then it declines 50% over the next 4 or 5 years. Keep that in mind. The higher your peak, the lower the longevity of the field and its reserves. It's always going to be the case. It's the case with shale. It's the case with offshore. Anything. That statement holds true for any reserve in the world. Record-breaking wells. We see IPs, 365-day IPs of 20 million BOEs per well. These will surpass your 75 million Guyana wells. And the number of wells needed to reach peak, 7 or 8 wells, and you're at the peak. That is how productive these platforms are. Or these wells in Johan Sverdrup is. The rest, all in terminal decline. It's older stuff. It's all declining. Even Johan Sverdrup now is at peak. Technically, it's flat or declining. Where is the future source of supply? CO2 emissions, I like to bring this up when I can, just because it actually matters to these major companies and their investors. These fields are already electrified. Norway is on a mission to electrify their entire offshore oil and gas developments. Should be a nice, good marketing for our industry going forward, that these offshore platforms are fully powered or energized by non-fossil fuel sources of energy. The fields also get reserves, just like Canada and our beloved oil and gas companies in Canada do. So this is something I like to track, is what is the reserves changes year by year. Some fields may end up producing more just because of the production profile for that year. Some fields might get downgraded. So you can see what the average deterioration is of that area on a year by year basis. Okay, so that's the North Sea. We will move on to the Gulf of Mexico. And appreciate all the information there, Energy Blogger. For anybody that doesn't follow Energy Blogger on Twitter, very deep, detailed information on offshore and posts. So I do appreciate your comments there. Okay, so Gulf of Mexico. Here is our Gulf of Mexico, all the way from Texas to Florida. Of course, a lot of this is, there's no oil or gas here. Offshore Texas, Louisiana, and then off the coast of Mississippi, a lot of developments here. We have 3 different planning areas. We have different boxes or zones, as we can call them, which is how they are sold or how they're leased out. Gulf of Mexico production. You will notice a couple of major incidents here, weather patterns, hurricanes. We see the Macondo incident, the Deepwater Horizon that happened in 2010, and the effect it had on production. Roughly, what is that? 40% decline in 4 years, 3 to 4 years. Every single barrel in the world is declining. Always keep that in mind. Don't let that leave your mind that, hey, if there is a moratorium on any new drilling, we get our typical decline curve falling off a cliff. Shale is even worse, but it applies to almost every place in the world. We see the resurgence after 2014, 2015, when the moratorium was lifted. And now we've peaked about 1.8, 1.9 million barrels per day. We saw 2 major weather events in the last 2 years, Hurricane Ida, of course, being the more severe one. And we're about 2 million barrels per day at this point. That's where we're going to stay. In fact, we've fallen from there down to 1.8 because of some of the decline rates, and a few very key wells have failed. They have not produced at what was expected. 10, 15, 20,000 barrel per day wells have completely failed. So definitely some technological challenges up ahead for the Gulf of Mexico. We saw lower production due to hurricanes last couple of years, but we're still in this 1.8, 1.9. You can see how the forecast is always bullish. For some reason, people always like to have this bullish forecast that, oh, not only are we going to produce our proved reserves without problem, we're going to bring all the contingent reserve online, and we're going to discover more resource. I mean, there's no surety that you're going to discover more resource in the Gulf of Mexico. Nothing tells you that, but yet it keeps being put into these presentations. Into the graphs about the future. Why? Because people hate to be wrong. They hate to be the guy that missed production going up. Whereas if it doesn't go up, you just blame it on hurricanes or lack of FIDs or whatever else, right? Think of it from the mindset of the person putting these things together. They're accurate up to a point. This is how an offshore platform looks. You have one floating production and storage platform, and you have multiple undersea pipelines that go to multiple undersea wellheads and risers and different fields. These are all different fields: Samurai, Khaleesi, Mormont West, and Mormont East. So what ends up happening from a development standpoint is, if you now go and discover something right here, you can bring it into the same FPSO. If you go and discover something that's slightly off screen, this FPSO can no longer access it. So now you got to decide, is the reserve big enough to justify a new FPSO? Or is that discovery just going to stay there until somebody else drills more next to it and they discover bigger fields, which leads to a more newer FPSO coming online? Until then, it's all about subsea tiebacks. That's all you're dealing with. And then you have your export lines, which go to land. These floating platforms in the Gulf of Mexico are close enough to land that they can send the oil and gas back onshore for further processing. They don't need to process it right offshore. Okay. The Gulf of Mexico rig count. You see what a one incident does offshore. The rig count cratered in 2010. It fell 80% in a matter of weeks and months. Okay, so there's a couple of comments here. So, okay, so I should clarify, on the Edward Grieg prospect that was discussed, 1 out of the 10 projects was the one that was chosen not to go ahead with. So there's 10 projects within Edward Grieg. 1 of them was not economical. The rest of the 9 were. So actually, I did read this just recently, and it just fell out of my mind at this exact time. But anyway, the Gulf of Mexico rigs fell down. They've since rebounded. We see Gulf of Mexico production. BP took a massive hit in 2010. Their production went down from 500,000 barrels per day to 200,000. It created this lack of certainty and clarity as to what was going to happen in offshore. So obviously long-term impacts of that sort of thing. And here we come to our optimism once again. In 2015, RBN Energy put this out and they said, oh, Gulf of Mexico production is going to just ramp up all the way to 2.2 million barrels per day by 2020. We didn't quite get there. So take that 3 to 5% that I had said, take that 3 to 5% off for every year in the future you're forecasting. You end up at kind of right where we are today. 1.8 is about 25% below 2.2. We're about 6 to 7 to 8 years in the future. And so take these graphs with a grain of salt. They're built with accuracy, but they're also, in my opinion, overly optimistic for a lot of the supply-based scenarios. The Gulf of Mexico also subject to hurricanes. They lost these amount of barrels in hurricanes every single year. So when you're running your yearly averages, keep this in mind. They lost 97 million barrels from Katrina. Hurricane Ida 2021, we lost 60 million barrels. It made a pretty major impact to commercial crude in the US in 2021, for sure. This was one that I was tracking on a day-by-day basis as to the impact of this hurricane. These other ones were also impactful, but not to the same extent, at least not to offshore oil and gas production. More impacts of hurricanes. We have tropical storms also shutting in production. You can see how the Gulf is just in this horrendously hurricane active region where it's this literally a Gulf where everything comes into the Gulf, and usually some of the platforms are on the path of that. This is Shell and their Mars platform. You can see Port Fourchon. This is the one that got flooded in Hurricane Ida and was down for many weeks, I believe. New Orleans, Louisiana, the Mars pipeline that goes into West Delta. And then from West Delta, you have other subsea pipelines going to Mars, Ursa, and the Olympus platforms with your greater Mars basin. This is a 700 million barrel recoverable basin, a very, very nice, juicy area that was discovered, produces about 250,000 barrels per day, a flagship development for Shell. And then with the Mars pipeline, of course, as well. Here is your Mars field cluster production. you can see how things, when oil prices go lower, production drops off really fast from offshore platforms because they require constant drilling and exploration and development and delineation to keep their wells at max capacity. Now, when they went down after the hurricane, they were down for a few months. Then they came online one by one. And we see the peak now is 180,000 barrels. So we've lost about 70,000 barrels in just 3 years. COVID has had a real impact on these high cost, high OPEX sort of developments. So always keep that in mind. COVID was not a thing that happened in a vacuum. There's a real impact on production globally going forward. Yeah, there's quite a few interesting documentaries on Deepwater Horizon. So if you're curious, I would definitely check that out. And then the full report, I can't remember how many pages it is, but it's a very, very detailed report that talks about the blowout preventers and the other well they had to drill, the relief well. It talks about some of the issues with Schlumberger and what happened there. Very cool, a cool background for sure. Here is the Olympus platform. So you can see it declined massively during COVID. They then brought on 3 new wells, including the power nap area. And it just goes back into its decline phase. The Gulf of Mexico is merely keeping production flat at this point. They are making up for declines for the most part, and that's their job, is to keep it at about 1.8 to 2 million barrels. I don't foresee any major increase happening here as time goes on. Cycle times. Discovery to first oil, we used about a 10-year example for Guyana. Actually, Guyana is still to be discussed, but 10 years. We will use a 10-year example for Johan Sverdrup. We also have data that shows about a 10-year average for the Gulf of Mexico, year from discovery to first oil. Sure, are some of the latest ones 5, 6, 7 years? Yeah, but they're also subsea tiebacks. They're not full FPSOs. So they're not full developments. They are, well, Kings K is an FPSO, so there's always rules and then there's exceptions to the rules. So I would still run a 5 to 10 year minimum to get these FPSOs online after discovery. We haven't discovered anything major worth doing these sorts of developments for in the recent past. Here's your Kings K, comes online 2023, 60,000 barrels per day, and off she goes on its decline. And one thing I want to point out here, 2022 and 2023 had some pretty big developments coming online in offshore Gulf of Mexico. So when you look at the EIA weekly production number and you're saying, or you're thinking, hey, shale is ramping up. It's not shale that's ramping up. It's offshore and some of the conventional wells is what's ramping up. Shale itself is doing even worse than what is being projected or discussed, given that some of the US production is now coming from these areas, not from shale. Certainly something to think about as you go through the EIA weekly numbers. It's not just shale that it represents, it's talking about US overall production. And this is your production forecast for all the projects in the Gulf of Mexico that were sanctioned pre-2022. So yeah, I believe that's what this chart shows. Yeah. Split by year, or sorry, split by operator. So 2022, the platforms that came online in 2022 have added a lot of barrels in 2023. So we are still yet to see the full impact of this. Like I told you, some of the wells have failed. So I don't think we're going to see this 300,000 barrel increase as projected, but still 200 plus in 2023 is on the docket. So once again, compare your EIA weeklies to other non-shale sources of production as well. Most of it coming from Shell. We have the Mars platform adding a few. We have BP with their Mad Dog 2, and then Murphy as well, drilling some very cool wells in the Gulf of Mexico. This is your Murphy oil, Kings K. You see how it adds. All it does is mitigate decline. That's it. It doesn't add any incremental barrels. We don't even reach the 2019 peak, or Murphy doesn't, despite the addition of this pretty decent sized platform and work being done here. Top US Gulf of Mexico fields in terms of average per well. You can see the EURs per well. Oxy has a Tonga West, which somehow just doesn't decline. There's some sort of natural reservoir they've hit there. And then the other ones, regular. BP Thunder Horse has been a massive failure, according to what they said it would produce and what it has produced. Not that great. And the decline rates are a lot higher than what they said it would be. Whether you want to treat that as a failure or not in your definition of the word is up to you. I think when you don't meet your pre-development EURs and your production profiles, that is a bad sign overall. BP Mad Dog 2 as well coming online. And some of the other platforms you can see here, make your own conclusion as to how things are going to go. See how the top platforms, the top wells ever drilled in the Gulf of Mexico are one-offs. 5 out of the top 6 are literally one well results, compared to Guyana, where you're seeing multiple wells producing at that exceptionally high rate. What do we have here? Yeah, this is top EUR per well. So this is now on a per well basis. This was on a per platform basis or area basis. This is per well basis. The top well in the Gulf of Mexico ever drilled is about 20% lower than the average Guyana well in terms of EUR. That's why I keep saying we only have one Guyana. It's not something you can use as a proxy for everything and just start slapping it everywhere as a loosely said term. Estimate EUR per well for deep water fields. Again, this is now on an average per well basis. Brazil, this does not have Guyana in here, so you can kind of refer back. It was 75, Brazil is 41, and so on and so forth. Facilities with extra utilization capacity. Again, some of these facilities are older, so now they have more and more production capacity that's yet to be used. Is it ever going to be used? Depends how many discoveries they make. On top of that, you have platforms with zero utilization that are now a decommissioning liability. Be very careful of offshore decommissioning liability. It is a real thing, and it is a major headache and financial concern, especially if a smaller company gets stuck with them going forward. You can see certain platforms. We have, I believe, Shell Perdido, where well below capacity. It takes away from some of the cost efficiencies of doing these sorts of projects, as well as, I don't know whose platform this is, Delta House, maybe Chevron or Total here. We also have some of the other, actually, this is all Shell. I think Shell also is Delta House. And then we have the gas fields having the same problem, where some of them in a year or two will be producing at 30% of their max capacity. Extra infrastructure sitting around, not getting the right amount of efficiency, operational efficiencies, because the geology means the oil is not there and the gas is not there. Quick comment on Mexico as well, since we're talking about Gulf of Mexico. Here is the Mexican offshore. The two major fields, Cantarell and KMZ, Ku Maloob Zop. The two major fields here. We look at Cantarell, an exercise in petroleum engineering failure. This thing fell from 1.5 million barrels a day in 2004 to literally zero today. That's how big the decline was. It declined about 70% in a matter of 5 years, 5 to 7 years, because of poor production operations, overproduction, and nitrogen injection, which caused geologic damage permanently. So now we have the KMZ field, the Ku Maloob Zop field. It slowly has taken on some of the brunt of the production, but also declining. And overall Mexican production is down 3.5 million barrels to 2 million barrels over the last 15 to 20 years. We're kind of looking at a trend, aren't we, where a lot of offshore is actually declining or stable at best. Here's your Cantarell. Here is your overproduction. This is what we would call overproduction of oil from a reservoir. Look up a shale graph, a US shale graph, and people argue as to whether it's going to look like a normal distribution or it's going to look like this debt-fueled, a lack of production expertise, production fall off. It's already occurred. I'm not making up production profiles and saying shale is going to decline at a much higher rate than people think on a basin basis. It has happened in previous cases of overproduction. So let's not take shale. I know this is not a shale focused presentation, but let's not take shale for granted that, oh, it can just do 5 million in the Permian forever. There's real severe, sudden consequences to overproducing your reservoirs and producing them the wrong way. Guyana, the one country out of only a handful that is actually increasing production. 66,000 barrels per day export in 2020, 266,000 in 2022. Growth rate about 100,000 barrels per year. This is the best of the best of the best we have. This is the creme de la creme for offshore growth. 100,000 to 200,000 barrels per year. In a world that consumes 100 million barrels per day. Exxon is aiming to be at 1.2 million barrels by 2027. They actually have the reserves to back it up. In other cases, I've said it's overly optimistic production profiles. In the case of Exxon and Hess and their Guyana, they have the discoveries, they have the reserves, and they continually are discovering more pools. So they're backing up their development with more exploration. So 2 FPSOs are on site currently, the Liza Destiny and the Liza Unity. We also have 4 more that are already sanctioned and FID'd that are currently being built. There is a 4 to 5 year cycle. When oil was first discovered in Guyana, it's been about 10 years. And not quite 10 years, but on an overall money spent, discovered, explored, discovered, FID'd, brought onto production, about a 10-year cycle here as well. And now they get a new FPSO every year because they've already FID'd them. So about a 220,000 increase every year, call it, because not one FPSO every single year, about 150,000 barrels per year increase in oil production out of Guyana. We'll see how many more we can find, because we need about 3 or 4 or 5 more of these in order to meet our growing demand, while the rest of the world declines or stays flat at best. This is what an offshore development cycle looks like. You have your CapEx up front, negative free cash flow, massively negative free cash flow, and then you start producing cash, and it has this decline phase on it with only 3 or 4 or 5 years at max production. So once Guyana gets to max production, expect maybe 3-5 years there, and then it's on its way down. The Stabroek block where Exxon is exploring has been quite successful, but they have also explored a lot of the block so far already. Here is your discovered resource, kind of getting a bit lower as time goes on. So they're not discovering exactly the same as they were. Here is the Stabroek block that Exxon and Hess share. Deep water, not quite ultra deep water yet, but also they are getting to having discovered a lot of this pool. I mean, very early yet, so no point getting pessimistic, but at the same time, to expect them to discover another 20 billion barrels over the next 5 to 10 years, we'll see. We'll see. If they can do it, kudos to them, but they have already been in the juiciest part thus far. Current production about 340,000 barrels per day. So Liza 1, 120, Liza 2, 220. about 340 roughly. One comment I will make on Guyana, Exxon got a sweetheart deal in terms of royalties, in terms of production sharing, in terms of tax laws. Don't expect any other country to get the same treatment. It's not even going to be close, which will restrict development in this area, despite the productivity of the wells and how good they are. The government takes about 50% of the free cash flow. We have discussed this earlier. So 50 to 60% of the free cash flow is going to go to the government here. The company gets the rest. They're saying about 130 billion of free cash flow over the course of the development. So Exxon's market cap right now is what, 400 billion roughly. So pretty major impact, but not crazy. At a lower oil price, it's not a game changer to the extent that people like to make it seem. To production, yes, but to money, really, they're only really going to make money at 80, 90, $100 oil and have it become a major factor in their free cash flow going forward. Suriname, very similar to Guyana. It's just on the east right here. So this is Guyana. This is the Suriname area. We see cumulative resource that was discovered in Guyana in green. We see the cumulative resource discovered in Suriname in purple. Not quite the same trajectory thus far. Sure, Suriname had a 2020 and 2021 that they had to contend with. At the same time, let's see how this pans out. Some of the latest information coming out is not the same bullishness as Guyana, not by any means at this point in time. So we'll see. Suriname also a bit more gas and condensate focused, whereas Guyana is pure oil for the most part. Here are the blocks, deep water exploration in Suriname. You can see the companies that are involved in this sort of work that they're doing here. Total, mostly Total and Apache. Petronas and Shell are newer participants. Exxon is not really a player in this. They have land way to the further east and more offshore. Yeah, and you see it here. Exxon's block is more deep water. Here is where the brunt of the development has been. And this is kind of interesting because this graph seems to show that there's more liquids being discovered, but there's a lot of gas as well in here that was hit, and more condensate rich liquids, or condensate rich oil is what they like to call it. So not exactly pure liquids, but yeah, the Maka and the Sapakara developments are going to be ones to watch moving forward. And then you have the discovered resource as well in a very, very tight area here thus far. Free cash flow, it's the exact same development cycle offshore. You have your high capex, low free cash flow as you build production up, and then you make your money as time goes on. The government takes 50 to 60% of your profits. Canada, Newfoundland and Labrador, mostly on the East Coast, is where the developments are. We also have some further to the southwest, but most of the bigger developments are over here. Offshore Canada blocks, you can see where the developments are for the most part. And then you can see what we call the orphan exploratory area, where nothing has been discovered thus far, but there's massive licenses that are being put out there. Of course, assuming the bid is successful. So far, a lot of unsuccessful bids on these, call it very high risk wildcat prospects. The map more zoomed in, we can see Hibernia, Hebron, White Rose, Bay du Nord. We have our orphan basin, and then you have these other basins. We'll see if something ever gets discovered in these areas. Is the potential there? Sure. Are they worth exploring at $70 oil? No, I don't think so. So definitely one to watch. It is a relatively underexplored basin. So we'll see if there's more discoveries that come out of here moving forward. Newfoundland and Labrador oil production declining to flat at best. you could say, definitely down from its peak. We have, what are the bids that are offered? How come bids were unsuccessful? Because it just didn't pay enough, or nobody bid on those assets. Here are some of the bids that were successful. $180 million was bid for Parcel 8. And I wonder if Parcel 8 shows up here. No. So $180 million just to get the right to go and explore on that parcel. This is a big boys game. I repeat this once again. Only the major producers can really have very, very successful exploration work being done on a wide scale. Well count in the Canadian offshore Orphan Basin, 1 well a decade, 2 wells a decade. That's it. That's all that's being drilled here. So if something is hit, it has a possibility of being a very large discovery, just because nothing has been hit so far in the Orphan Basin. Here is a projected production. We have our legacy productions dropping, Hebron, Hibernia. We have the West White Rose extension that's going to happen, come online in the next few years. And then you have Bay du Nord, which we'll see when it finally comes online and what the economics are around this. Obviously a big wedge of production, but too far out right now to make any sort of meaningful projection. And either way, how much production do you increase? You increase 150,000 barrels in 10 years. The global oil and gas supply market is way, way tighter than that. It's way more sooner than that, where we need the supply to come online. And I do understand this has kind of taken a macro turn where I'm discussing why offshore doesn't really have the capacity at this point to meet our growing demand, but that's just the reality of it. And we have to keep tracking these every single year, every single quarter to make sure that doesn't change. Do the Canadian oil companies have exposure to offshore Canada? Cenovus and Suncor do, I know for sure. I don't know who else really. I don't focus on this part of the world all that much, but I know Cenovus and Suncor for sure do. The rest, I'm not sure. Offshore exploration in Canada, relatively muted, 3 to 5 wells a year. That's it. Nothing really crazy. The discovered resource is not that great. Only less than 2 billion barrels of oil discovered in the last 20 years. Not enough to justify more and more spending unnecessarily, unless the geology proves something at some point. Brazil. Petrobras makes it very clear. It's very easy to tell which FPSOs are coming online, how much they produce, when exactly they're going to be expected to be at full capacity. And 50% of the world's FPSOs in the next 5 years are in Brazil. So it already tells you where your focus needs to be in terms of figuring out, is deep water for real, or is your ultra deep water / deep water also going to have some problems? Production delays, labor issues, cost inflation, pushing back of FIDs, et cetera, et cetera. So this is off the coast of Brazil. We have our Campos Basin, which is our legacy post-salt basin on top. We have our Santos Basin pre-salt on the bottom here, which is really where the bulk of the development now is, including the Buzios field. Very, very nice field. You can see Buzios is going to have 11 FPSOs by 2027. Very nice production as well. They also break it down into a table for you. So if you go to their earnings releases, they will tell you the FPSO capacity, the startup, the stake, which really doesn't matter to us, and then the status. What has been done? Is it in execution? If so, in what stage of execution? How many wells are drilled and completed? And this gives you a very clear understanding of Brazilian oil production for the next 10 years. There has been some discussion around this, that Brazil has never met the production number that they say they will meet ever. True. They also were doing these projects in a lower oil price environment. The pre-salt is now getting more and more a part of the overall Brazilian production. The pre-salt has a lower decline rate. Don't count Brazil out. It would be a mistake to count Brazil out in their production profile going forward. Do I believe it right at this exact moment? No, but it is something that one should watch very carefully if you're an oil and gas investor for the longer term, what Brazilian production is looking like as the years go on. They can be a major force going forward. Here is the Campos Basin Development Plan. You see how this is in its maturity phase now, the post-salt development. Yeah, they do have some FPSO still coming online, but it's in a major decline phase. This field produced 14 billion BOE until 2 years ago. It's going to produce another 5 to 6 billion BOE as it goes into its blowdown phase. 20 billion BOE produced. Now compare that to Canada, which we just discussed. Only 2 billion BOE was found in 20 years, from 2000 to 2020. Where should your attention be focused if you're worried about new supply coming online? Right? That's the point I'm trying to get across today in this presentation. The Buzios field that they found, pre-salt, the reservoir thickness is 500 meters of reservoir. The extent of it, the aerial extent, is 210,000 acres. So not massive, but think of a regular company's Montney acreage holdings, but it's 500 meters thick. So very nice, very, very nice wells, low decline because the reservoir thickness is so much, it just naturally sort of flows. 26 to 30 API, medium grade oil, awesome. They have four units online that they've put on. Each unit weighs 77,000 tons. So when we talk about the scale of offshore, everything is bigger. That equals 420 Boeing 747s. Not sure I would use that comparison, but that is kind of what they've decided to use. Each unit has about an 11-month installation cycle. So we'll see, can they actually keep on that? Or are the labor problems and the supply chain issues going to delay these? This is also a higher complexity oil. It is a sour oil with CO2 in it. So keep that in mind. As we go to lower quality reservoirs, even when we hit the higher quality reservoirs, some of them are going to be sour. Some will have CO2. Some will have lower porosity. Some will be more heterogeneous. There's something that caused this oil not to be produced earlier, and this is more prevalent in the Middle East than in Brazil, but still holds true. Some of the oil may be heavier than what you're used to producing. A lot of flow lines, a lot of wells. This is a pretty massive operation that Petrobras in Brazil has taken on. The Buzios field was 0.2% of pre-salt production in 2017. By 2020, it was 34% of pre-salt production. It is going to be upwards of 60 to 80% of pre-salt production as time goes on. Once again, we have limited hours in the day. Focus on the fields and the assets that matter, track them religiously, and you will get a very good idea when things are changing before they change. So where are we now? Yeah, so it's 34% of pre-salt production. Peak wells can produce up to 70,000 barrels each per day, BOEs per day. The average production is 36,000. Very nice, 100 million BOE produced in 18 months. It goes to show the low decline rates of these wells. However, there's a lot of issues. The CO2, the H2S, high temperature, high pressure. You have a seabed you're dealing with. You have a 6,000 feet salt layer that you have to drill through. And your total depth is almost 6,000 to 7,000 meters. So you're really out there drilling deep, very expensive wells in heterogeneous rock. The rock is not all the same. It's different, very technically challenged area that people are in. Here is your Buzios now. The investment's $47 billion going into Petrobras CapEx 2021 to 2025. Buzios is almost half of that. Here are your FPSOs. Here's your production capacity, your production participation as well. Here is your overall production cycle of Brazil. It's not even that deep water is now in, it's literally just pre-salt. That's your production. Everything else, major declines, at least compared to the historical production that Brazil had. You can see how the decline rate is relatively high here. The Brazil post-salt, I think they call it post-salt, I want to say. Yeah, the Brazil post-salt and other oil production has a higher decline rate than normal for offshore. The pre-salt has a lower decline rate than normal for offshore. So Brazil, they should really be able to sustain their production now going forward a lot easier because of that significant geologic difference in the actual reservoir characteristics going forward. And you can see how their ultra deep water has such a crazy decline rate on it. And why Brazil had problems in the past keeping up their production. This chart comes from Energy Blogger. It shows you what their growth rate is. They're saying about 500,000 barrels of growth by 2027. 125,000 per year. Once again, not enough to really make a major difference. Guyana plus Brazil, call it 300,000 barrels per day of growth every single year. When world demand continues to go up more than 1 million barrels per year, plus the worldwide onshore and shale is declining, we'll see how large the gap gets as the years go on and what oil price is required to incentivize new exploration and new development. Saudi Arabia. We have our maps. This is Saudi Arabia onshore, the Ghawar field, Granddaddy Ghawar. We have Abqaiq, we have Kurez, the major fields here onshore, as well as all the smaller fields more to the north and to the south as well. But we can see the aerial extent of Ghawar and why it is and will be the world's biggest onshore conventional field ever. In terminal decline now, but still the world's biggest field ever. In terms of production, let's say. So offshore, we do have some nice fields offshore. We have Zuluf, Safania, Marjan, and Berry. These are kind of your main ones to focus on. They have been in production for the last 40, 50 decades, or 40, 50 years, some of them. But now they're going deeper. They're drilling the heavier oil. They're bringing production more higher because their onshore fields can no longer maintain that 10 to 11 million barrels per day of oversupply, of total supply. Yeah, post-salt for Campos. Okay, no, good to know. I wasn't sure about that. I was just making my own definitions there, but it's good to see that it's real. So one of the fields, we'll talk about Zuluf. So Zuluf field, 240 kilometers north of Dhahran, which is your main engineering and expat area. The Zuluf field is undergoing a major expansion to add 600,000 barrels of Arabian heavy. The field has been producing since 1973, 800,000 of Arab medium. When Dr. Anas is on Twitter saying crude quality matters, this is what the referral is to. It doesn't make a difference in 1 year or 6 months. It makes a difference to your global crude slate going forward is getting heavier and it's getting more sour with more contaminants and more irons and sulfides within the oil. So we go from producing Arab medium, now we're declining Arab medium, we're adding Arab heavy. Keep this in mind when you talk about Saudi can add this many barrels or do this and that. Sure, they can do it. Which refiner wants that grade of oil? What are the products that can be created from that grade of oil? Think a little deeper. Always, nothing is going to be just given to you on the surface. And massive reservoirs. The Zuluf and Ribian, 31 billion barrels in proven reserves in this field. Wow. So no wonder they can produce 600,000. We'll see. This is what they're spending money on. So this is their brownfield existing projects. Then you have the Safania, Berri, Zuluf, and Marjan. Your 4 fields. They get different money at different points in time. Keep in mind, their onshore is still declining while they bring this offshore production online. So what does it end up at? Well, they said they want to get 13 million by 2027. They also say they're at 12 million in 2019. Are they? Is that the real capacity? They've never hit it or been able to sustain it. So we can already knock down 1 to 1.5 million barrels from what they're going to get to by 2027. So 11.5. That's also assuming decline rates don't accelerate in their existing fields. When you have a field with high water flood, high amount of recovery factor, high drilling locations that you've already drilled, you might find some of the wells water out suddenly. So in a everything works for Saudi scenario, they can increase production from today's numbers, call it roughly million barrels per day by 2027. That's also assuming all these fields pan out exactly as they say they would. By the way, Saudi just announced that some of their projects are getting delayed because of supply chain, because of labor, because of the inability to bring those platforms and get them properly operational, get the wells drilled. You can see, I mentioned earlier, the rig count is going up big time. So just keep this in mind. This is all nice to talk about, that Saudi is going to do this by this year. Let's see it. Let's see if it can actually be done. And then on top of that, the onshore decline cushion, we don't know. We don't know what the onshore decline is going to be on these major fields as time goes on. We also don't know if these new fields are going to produce exactly as what they say they are. If the oil is a little bit heavier than expected, maybe the field can only produce 10, 15% less maximum rate than what was advertised. But again, I want to get people familiar with these names so you can focus on any news or developments about them. Safania, Zuluf, Berri, Marjan, the 4 fields to really focus on. Yeah, so I didn't talk about Jafurah in this exact presentation because it is more of a unconventional development, and also we don't know what impact it's going to make. It increases gas, and then they can sell more oil to the global markets as a way to hide their true production capacity, because Saudi does consume over 500,000 barrels of fuel oil or raw crude every summer for their power generation and AC demand. So they're doing a lot of good things. At the same time, their fields are declining, and we'll see what happens. Saudi Arabian gas supply. So some of the gas that comes online with Jafurah is going to be additional demand. When oil and gas prices are high, OPEC countries see their GDP increase by 7, 8, 10, 12% per year, which brings with it additional fuel consumption and gas consumption. So as Saudi Arabia's domestic gas production goes up, their demand looks to be rising at the same rate, meaning none of this is going to end up on the global markets. It will all be consumed internally. This is a point I really want to stress. Whenever a country is saying we're going to increase production, don't just take the excess incremental and add it to your global supply. If a country is increasing production, it means times are pretty good, which means their internal GDP is going to rise pretty high, which means their internal petroleum consumption is also going to rise, especially when you're talking about projects that are 5, 7, 10 years out. Keep this in mind. It applies to various countries. including Mexico and Saudi, and really any oil producer that doesn't have a massive excess production like a Canada, for example. Yes, and also correct. The fact that Saudi is going into unconventional shale fields onshore, what does that tell you about the state of their conventional fields and the decline they're under, right? Not everything is going to be given to you, especially with OPEC. You really have to read between the lines that are between the lines to figure out what's happening. Here's the Saudi jackup rig count. You can see how much CapEx they're spending in order to get their supposed production increase 4 years down the road. So we'll see how it plays out over time, and what they can really get to, but definitely a country to watch because they are putting their money where their mouth is in a big way, a big way. And this graph here should tell you something as to the degradation of Saudi's onshore fields as well, and the well productivity or a basin productivity, how many rigs are required to keep their production going at that same level. This is your geology of some of the offshore fields. I believe this is Safania offshore field geology. And I had discussed this in my enhanced oil recovery presentation. You always need a source rock. You always need your permeability reservoirs, and you need a seal rock. That is going to be true for any oil reservoir in the world, oil or gas. Source rock, permeability, sandstones or carbonates, and then a seal rock, which is typically shale of some very, very low permeability. So we see here we have gas in Safania, deeper gas. The deeper you go, the higher pressure, the higher temperature, some of the organics will convert into gas. You have your oil in the Jurassic age, and then you have a immature reservoir as well here. So you have oil, but it's immature, it can't be produced. Very cool geology for those that care to look into this. I myself am no expert in geology, but I love reading more and more about this now, and I hope to share more about specific reservoirs and what makes them so nice and productive as the presentations continue for the rest of the year. Okay, so that's Saudi. Now let's talk about UAE, United Arab Emirates. These are their fields. They have onshore as well as offshore. The ones to watch for is your Zakum field, which is really a very, very nice field, along with some of the fields. So Lala, Shaif. This is your Zakum. So instead of building all FPSOs, they built artificial islands in pure Arab fashion. They built 4 artificial islands, which they use to then drill up to 30 to 40 to 50,000 feet horizontally. Really, really cool work being done here. That's 7, 8, 10 miles laterally. Really cool, minimizes their cost and gets everything in one area for them. Here is your Upper Zakum development, 4 artificial islands. The largest is the size of 135 American football fields, 1 million barrels by 2024. We'll see. We'll see. UAE is one that does have the production capacity, but they're also under the thumb of Saudi Arabia and OPEC to not go out and build out all this excess, or not go out and produce all this excess spare capacity. So when we talk about OPEC spare capacity, UAE is the one to watch because they do have the capacity and they're spending more money to pre-build it before the time comes. More than 1,000 well slots, well lengths up to 35,000 feet, but they just drilled a well that was 50,000 feet, the world's longest well in Upper Zakum, all the pipelines and all this as well. So we're getting to pretty state-of-the-art developments and very expensive developments in order to produce oil going forward offshore. Nice growth trajectory. They grew from 2.5 million to 3 million barrels per day in the last decade. And they have ambitions of getting up to 4 and 5 million barrels per day. Can they do it? Yes. UAE is one of the countries that does have the geology, and they have the low recovery factor fields in order to do it. The thing is, UAE is very, very cohesive unit with Saudi Arabia, very cohesive. They are on the same page. Expect them to control that part of the market going forward. And also, OPEC has to take into account other countries are declining. Countries like Kuwait, they have to make up for these countries with some of the producers like UAE and possibly Iran, but Iran and Iraq have their own geopolitical issues that transcend what Saudi Arabia can do and control. Unlike UAE, which is very, very straightforward and easy to deal with. Here's your UAE supply demand on gas. So we see the gas demand is relatively matching export or relatively matching production, meaning no extra gas supply here, only oil supply coming out from UAE. Iran, here is your Iran onshore, many, many fields, and your offshore. This is the field to watch, your Pars field. You have your South Pars, which Qatar controls. You have your North, and then the North Dome on it, which goes into the Iran part of the field. Iran's dry natural gas production, very nice. They have 4x'd it in the last 20 years. Their internal consumption goes up very, very significantly too. So just last summer, they were saying, you guys need to stop consuming natural gas because we don't have the production capacity. Iran said this to their own citizens. That tells you the state that, okay, their production has gone up, but their consumption has also gone up. Iran production onshore versus offshore. You can see how a lot more of the BOEs are getting into offshore, about 50% at this point. In 2005, it was about 20%. So countries moving more offshore as well in Iran. And Iran also is in a very interesting geographic area where they control the Strait of Hormuz. About 35 to 40 million barrels go through the Strait of Hormuz. This is a very significant area for world crude trade. You can see where it is right here. And something that people should be watching and tracking as part of their geopolitical tracks. This is if this strait closed down, you would have multi-million barrels of oil stuck and unable to get to the global markets, stuck in an area with relatively low storage capacity. So when we talk about geopolitical risk, there's nothing greater to oil markets than the Strait of Hormuz, and some pretty interesting tensions developing along with the tensions being fixed as well. Very, very interesting area nonetheless. The South Pars and North Dome, when we talk about these two fields, trillions of cubic feet is what we're discussing. Between the two, they have 1,800 trillion cubic feet of gas in place with about a 75% recovery factor. So about 1.3 trillion cubic feet recoverable. 1,300 trillion cubic feet recoverable. My apologies. And that is about 20% of the world's global proven gas reserves are in this one field. So a major one to watch if you're watching global gas production, global offshore gas production. Are you watching LNG export capacity? Are you watching global gas supply demand? Here is the one field that you must track. And to put it into perspective, this North Dome plus South Pars jointly owned field contains just as much reserves of gas as Russia. These two countries in one field have just about as much gas reserve as Russia. And about, this is an older pre-hydraulic fracturing graph, but significantly more reserve than even the US, despite the US producing about a third to a quarter of global natural gas. Kuwait, a couple small points. They have the Safaniya field goes into Kuwait along with the Khafji, and the Kuwait has their own fields, but nothing really that's all that interesting here. Their onshore Burgan field is in terminal decline. really suffering from some issues. The onshore neutral zone fields are sources of new oil supply. So one to watch for those in the oil and the offshore as well. They have 3 or 4 fields that are in the neutral zone, which they finally have figured out how to share the profits from it. And so they are targeting these moving forward. Kuwait gas, they don't have it. They are in an undersupply forever. So expect this to continue. Don't expect any gas, offshore gas reserve from Kuwait entering the global market. Qatar, we talked about the south pars and the north field. Oil production for Qatar, relatively flat. The gas production had a massive rise and is now flat. So they've actually not developed this field as much as they could. They've developed it up to a certain extent. They've created their LNG facilities, and then they've kept it flat there for the last 5 or 6 or 7 years. So far looking good. Still want to watch because they can increase production if they really wanted here, given the size of the field. It's just so massive. I believe it currently produces from this field 40 to 60 BCF of gas from here. So think the entire Haynesville plus more, or think Canadian gas production times 2 to 3 is produced in this one field offshore. Very cool. Yeah. So my apologies. I thought this was called the North Dome, but it's actually Iran that owns the South Pars, and Qatar has the North Dome field per se. There's another question here. I appreciate this. I've discussed this with a lot of people. PBR as an alternative investment. I'm not going to make any distinct comments on it. All I will say is it trades at 1/4 the valuation of ExxonMobil. I compared refining, production assets, I compared pipelines, I compared development, a profile, everything. 1/4 the valuation of Exxon. Whether you think the risk is priced in or not, that will be up to you to decide, but a 75% discount to what ExxonMobil trades at currently. So here is a little bit more about this field. You see the different refineries they have onshore, the different oil terminals, and then the different oil extraction fields within the North Dome, along with some gas projects going on here. And yeah, whatever else they're doing here. This is a very nice, concise little map that shows you everything. That's what's happening. It shows you the reserves as well. And I believe this is updated every year, if I'm not mistaken. So you can get these and really get to understand a country and what their future potential is from these source maps. Here's the North Field gas production. So yes, we are up to about 40 BCF per day, and a few little projects coming online that do increase production 2028 to about 55 BCF per day. In comparison, global gas demand grows at about 10 BCF per year. So the growth in Qatar and Iran's field makes up for 1 year of growth of global gas demand over the next 4 or 5 years. LNG output, relatively flat so till 2026, and then it goes up with the addition of 2 new projects that come online. So not a major player in LNG growth, a major player in LNG capacity currently, not in growth until 2026 or 2027. Israel, I will just mention this because they had the best gas wells out of any offshore gas wells ever drilled. So they've got their current production slightly growing. They've got a few fields offshore. The Karish field is pretty interesting because it just had its first ever crude oil export in February. So, hey, not the biggest market, but when countries are doing good things, they are developing their assets. I always like to share what they're doing. They've got some nice fields here, Leviathan and Aphrodite, and the Dolphin as well. So we'll see how these get developed as time goes on here and expanded. Egypt, a growing area. They have had a lot of decline, but now a little bit of resurgence looks like. Lot of major players here. You see them here: Exxon, Shell, Total, Chevron, BP, Eni. All of them are here. Mostly gas here. So we do see a little bit of oil development offshore, but also a lot of gas development going on. We have a lot of wildcatting going on. We will see how they do and what kind of production comes out of this moving forward. When I look at resource and development, we want to look at what is being developed once again. Just like Safania or the Saudi Arabian fields are going from medium to heavy oil, look for the resources and where they are. Sandstone. Is it Cretaceous? Is it in the desert? Is it in the Gulf? Which formations is it in? If you know which formation the reserves are in, all we do is go online, look up these formations. What kind of oil do they produce? Is Egypt's oil getting heavier? Is it getting more sour? I don't have the answers to these questions, but they can be easily found just by looking at the reservoirs and the type of rock that the reserves are in. And by the way, this applies to any Canadian E&P as well. It's not just offshore that this is relevant to. It applies to any Canadian-based onshore E&P for the same. And this is a graph of Israel actually that got pushed, or no, this is Egypt, yeah. So Egyptian domestic gas demand is going up substantially. It's going to overtake the supply by 2025, and then Egypt becomes a net importer of gas, even more bullish for our overall oil and gas macro, more so oil, but even gas has some tailwinds to it going forward. We see the same graph here. We are at about zero balance at this point in time, where we used to be able to export a little bit of gas outside of Egypt. Russia, the big one. They have the offshore Sakhalin developments. So Sokol grade oil, Vityaz grade oil. We saw when the war first happened, the Sokol grade completely dropped off. It is now slowly starting to come back, some of the Sakhalin activities, but some of these grades completely fell off. This is all offshore. This is where Sakhalin 1 and 2 are. There are Sakhalin 3, 4, 5, I believe, planned. We'll see how they do. I have shared this before, where not only is Russia going to lose production because of the sanctions and everything else going on, their future projects are in jeopardy. The projects that we're going to do to increase their oil production or mitigate decline are in jeopardy. They don't have the funding and they don't have the internal expertise to get them all done. So there's a chronic short-term effect, and then there's a long-term effect to what has happened in the last 12 months. This is what Sakhalin looks like. Very, very cold, very aggressive acreage, icebergs floating around, bumping into your platforms and rigs. Very technically challenging area. Oh yeah, here are the other Sakhalin developments. So you can see the different blocks around and where the developments are or are going to be, or where they're proposed, who the operators are. Of course, Exxon, no longer operator of Sakhalin 1 after they were punted out. Russia discovered resource by hydrocarbon type. They have a lot of gas resource, less oil resource. We'll see how that plays out going forward. They also have a lot of offshore resource compared to onshore resource. So just look at this graph and where the discovered resources are that Russia owns some way or another through Gazprom, through some of the other ownership stakes in other companies, etc. Here is the discovered resources by hydrocarbon type, just for Russia, within Russia. Looks to be mostly gas developments that they're finding recently. Good sign for the oil bulls. Also looks to be a lot of offshore that they're finding recently. More cost, more technical challenge, more tools required, more labor required. a continuous headwind from them from this point on, again, given last year's activities. Here are some of their activities in the Kara Sea in the north of Russia. You can see they're finding pretty decent sized discoveries, 480 million barrels BOE, over 1 billion barrels BOE also found. But once again, mostly gas, lower value product. And look at where the Kara Sea is. Literally in the Arctic. So high technical challenge area. When countries and companies are moving towards these, it once again tells you the scale or the condition of their current production and what the profile looks like. Here's a gas production that they want to do from Kara, 100 BCM a year by 2040. We'll find out. Let's see how this sanctions impact is over a longer decade long term. How interested are companies to go back into Russia and help them out with more development? So should be a very interesting next 5-year cycle here, or possibly even longer, as we've discussed. Kara Sea, here is the legacy Russian production. You can see how it declines. You have the Vankor cluster, and then you have the Vostok oil fields, which actually India wants to partner up on, and we'll see if they can provide the same expertise, the same tools, the same labor as required. But either way, Russia has gone from a stable to growing producer to now a declining producer, with their new fields keep getting pushed back if they can ever bring them online in the first place, in the current climate that they're in. So watch for this to become a tailwind for global supply demand from an oil investment perspective as the years go on. Here is some of the geology in Russia. Multiple fields, multiple stacked pay, large fields. When they're in this sort of fashion, I would like to think they are gas fields, because gas will naturally migrate into a cap-like fashion. It's in Russian, so I don't know what it's trying to say, but either way, very nice fields. Yamal Peninsula, Kara Sea. These are some of the names to start getting familiar with if you're talking about offshore Russian oil. And onshore. They're not all offshore. Here's Russia's LNG production that they had planned, 70 MTPA by 2030. Now we're looking at 45. So more impact due to the sanctions, more impact due to the invasion, and lack of expertise, lack of developments going as planned. Nigeria. So yeah, I can't take questions, unfortunately, by audio. So if you have a question, please just type it, and I will try and address it here accordingly. Much appreciated. So Nigeria, we have a lot of offshore development here. Oil in green, once again, gas in red. We have some of the latest OMLs, which is their way of dividing up the blocks in Nigeria, come up for development. OML 30, the investors in Africa Oil will be very familiar with OML 30, Egina and Akpo discoveries and developments. So nice little fields. They have been discovered, they have been produced. There's still exploration to do, yes, but the Nigerian environment is not quite safe at this point, along with some of the majors pulling out. I mean, Shell used to be a major player here in supporting development and even just the social causes, and they want nothing to do with it anymore. So pretty big failure politically here, and from the theft and other incidents that have been happening. So not seeing too much for growth here, but there's a lot of fields, and here are some more of them, just because Africa Oil has such a good slide on it as to some of the activities being done in Nigeria and some of the other areas around. Here is we once again bring you our forecasted graphs, which are overly optimistic. In 2009, they said Nigeria was going to be at 2.5 million barrels by 2015. It's currently sub 1.5 million barrels. Angola, they said, was going to be 2.5 million barrels. Nowhere close. Libya was touted as producing 2 million barrels by 2015 per day. It's at 1.2 currently. Algeria, I'm not sure where it is, but I'm thinking Algeria is not a 1.5 million barrel per day producer. So always take future production forecasts with a grain of salt. Don't let people fool you. Don't let them salesman you into these very optimistic numbers going forward. It doesn't work that way. There's always technical difficulties. There's usually delays, and the reservoirs that they're extracting and developing are usually lower quality than the proxies that they're using in order to generate these sorts of production profiles. Okay, so here's your Nigeria production outlook. It's looking like into the declining phase. Yes, Nigeria has production that's been stolen that will come back into the official estimates. Doesn't mean it's new production. It just went from being sold illegally to being sold legally. So planned projects not looking too good for Nigeria quite yet. Angola, just a little bit to the north. Yeah, I believe it's to the north. Either way, you can see Angolan production, what's happened here. Since 2015, they never got to their 2.5 million barrels, first of all, to begin with. And once the oil price fell out, they lost about 700,000 barrels in the last 7 years in oil production. So when we say Guyana is adding 100,000 a year, 200,000 a year, there's countries that are losing 100,000 a year of production without even talking about the new oil demand that comes on every single year. Here's Angola. We see all the blocks and the operators. So for anybody wanting to look more into this, these are your major producers and blocks. We also have 2 countries on top of Angola, Gabon and Equatorial Guinea. Here are their production profiles. Not looking too hot. Equatorial Guinea is down from 325,000 barrels a day to 50,000 in the last 18 years. Gabon is down from 270,000 to 190,000. Terminal decline. Nobody's investing in these areas, and the easy oil they had has been produced. Here is some of their Angola's latest developments. So the biggest one is gas. Then they have some smaller oil fields. So all around, we'll see what kind of production they bring on, but it's barely mitigating existing declines. They're not big enough fields to add to new production, and not in a material way. How much is going to cost them? A lot. It's going to cost them about $2 billion a year in CapEx to get this production online. And on top of that, it doesn't come online until 2026 at the earliest. What does come online in 2020, by the time they hit peak, is 2028. It adds about 225,000 barrels per day. Natural decline till 2028 will take care of that. So a point that I'll repeat once again for anybody that maybe is new, just because you decide to invest offshore and the FID is done, add another 3 to 5 to 7 years before the oil comes to market. And therein lies your caveat to the structural bullish oil thesis, is when people realize we're in this undersupplied market, you have a good 5 to 7 years after that, once the investment starts, in order to get your market back into balance. So pretty good going forward when you look at it from that standpoint. Morocco, 1 well per year is what's being drilled, if that, in Morocco. Not showing much. The most recent ones are either gas or dry. There you go. And some of the wells that are planned for 2023 here, I'm watching this well very carefully, this Eni Cinnamon 1 well, along with various other wells, as to see the results of them and any new basins that can be delineated. China mostly runs their offshore through CNOOC. The name literally has offshore in it. CNOOC, China National Offshore, Freudian slip right there. So 4 areas: Western China Sea, Eastern China Sea, and then the Bohai. is your main areas. Older graph, so take that into account. They have the Bohai, shallow water, 10 to 30 meters, very easy to extract heavy oil. And then their other ones are in a little bit more deeper water, 100 to 300 meters, that they're now targeting, all on the eastern side, obviously. Here's the offshore gas production, also rising. Also, CNOOC owns, as I mentioned earlier, production shares in a lot of other companies and in a lot of other prospects. So they use that as a way to increase company production without it being domestically right in China at that exact moment in time. So here we see China onshore and offshore. Offshore is becoming a bigger chunk as time goes on, a trend that I said you would see many times earlier in the presentation. So you're seeing it now once again. ConocoPhillips also used to be, or maybe still is, a producer in China. I want to use an older graph to make a point that offshore has risks. When you have oil spills and incidents like Deepwater Horizon, Macondo, production drops big time, big time. In 2012, Conoco had an oil spill in China and production fell 25% in 1 year. So whenever you think about offshore, be very careful of incidents that can happen, especially when you're investing in singular non-major companies where the incident will bankrupt them. Any sort of incident like that, an offshore blowout or a massive spill, call it quits for that company, it's over. So certainly some incentive to stay in the majors when it comes to the offshore developments and exploration. And this is what happened in 2012. They were drilling this well and they ended up hitting some sort of fault, natural fault. And because when you drill, you have a overpressure usually in your drill hole. The overpressure caused this fault to open and oil and gas started seeping out on the subsea. Like, the most bizarre things can happen offshore, and a lot of things we try and fix through engineering, geology, geophysics, subsea work. Not everything exactly can be mitigated. Insane things can happen offshore, especially when you're talking about the pressures and the temperatures and the depths that these go to. Yeah. CNOOC's oil and gas production rising. Some of this is because of non-Chinese owned assets. So just keep that in mind when you're thinking about CNOOC in a global supply and how much percentage they are. Same graph all the way till 2025. So what they're saying, 70% from China, 30% global. And when your Chinese national offshore company is looking for investment opportunities outside of China, again, what does it tell you to the quality of reserve and acreage that exists offshore China? There's a limit to it. Here's the consumption and production within China. They produce about 4.5 million barrels right now per day. Their consumption just hit 16 million barrels per day. And the self-sufficiency of China versus the US. So I don't want to make any comments on this graph, but you can see why there are certain limitations to taking over the world if you don't control the world's energy and you're not self-sufficient by any means on your energy, and how Russia now plays a role in that. We could talk for hours and hours as to that, but I do like supporting some of the more narrative-based conversations on Twitter with a graph that people can maybe refer back to when they want to make their points. Okay, so we got, I think, 3 or 4 more areas left, and then we'll wrap it up. We always seem to run over time, so yeah, we'll just keep talking here. So Malaysia and Thailand and Indonesia, we have 3 different areas with their own exploration and development. This acreage is relatively well produced. Also, it's a higher cost acreage just because of the technological and geological challenges that are present here. acreage awarded. You can see in each of the blocks how much has been awarded here in 2020, 2021, and 2022. We see some of the blocks that are still out there that are unawarded, and some of the companies that are involved. Of course, given that this is the Southeast Asian market, we have our local companies now show up: Petronas, Pertamina, and what's the other one? PTTEP. So should be interesting to watch these and what they can find going forward. Lots of tiny little blocks and discoveries, as opposed to major fields that are discovered. The same for Malaysia. Here's the yearly production trend. You can see why I said the reserve is not that great anymore. They have well produced what they've done. Same with gas. Gas is relatively still better, but oil production definitely dropping off in its terminal decline phase after a few fields came online in 2017, 18, 19, and 20. Looking now back to its decline. And the new startups don't look that great either at this point in time. We'll see what a higher oil price environment can do. Same in Thailand, Cambodia, Vietnam, relatively smaller producers, but hey, we'll still mention them because they are an offshore oil and gas producer. Some of the work commitments. So whenever you sign up for these acreages, you not only pay a fee upfront, you have to have work commitments where, okay, this is what you will do in the next 24 months. So we see a few exploration wells coming online and some pretty massive acreage here. So if they do hit something, could be for sure one to watch. This is just showing the new projects in these countries and when they come online, how they come online. Keep in mind, this is not actual total production. This is just showing the new production, and then you have to separate the decline rates from this to get the actual incremental barrels online. Here's your production forecast. I believe this is Malaysia, if I'm not mistaken. So one of the countries in that area anyway, is either Malaysia or Indonesia or Thailand. I should have labeled this a little bit better, but decline, a small little growth wedge, and then decline once again. Vietnam gas production. Keep in mind with these changing basins, when you have your majority of your production from one basin, and then it falls to 20% of your basin, 20% of your production from that basin in 10 years, try and understand the geological characteristics of these new basins. Are they the same well productivity? Are they the same geological risk? What kind of oil are they producing? What kind of gas are they producing? Is it mostly methanes? Does it have contaminants in it? Is it sour? We'll give you a better understanding of some of these basins and the difference that it makes going forward. Always keep in mind, the more shale unconventional we have, the higher the world's global decline rate is. That's a fact. That is just how it's going to be. Unconventional will always have a higher decline rate because of the way the pores are kept open and permeability is created. It's not naturally there. Malaysian gas production, relatively flat, nothing much happening here. Development cost per barrel. I come back to this once again. UAE has a lot of undeveloped oil fields and gas fields. Doesn't mean that they're all compete economically on a global basis. Malaysia's fields are in this case a lot better when you talk about sour gas fields. Okay, there's a lot of conversation going on. Yep, okay, so there's some conversation going on about Petrobras here in the chat, so I'll leave that be. Namibia, we have 3 major successes so far. Venus, Graph, and Yonker, is it? That was just last month announced. In the last month that they have hit commercial quantities. These are the geology here. We see Venus went deeper into the Albian geologic era. We see the Yonker well has hit 3 different reservoirs. And then same with the Graph. I believe Shell is owning Graph, so they also have hit 3 different reservoirs. Early in Namibia yet, and we'll see how things pan out over time. This is what happened in Namibia. Echo Atlantic drilled the Guyana well, came out dry. And then this Yonker 1X development was just announced last month, and significant discovery is what they're saying of light oil with associated gas. So we'll see. That is the Venus prospect that Total did. The Yonker prospect also has hit oil, and we're going to see what kind of reserve it comes out at and the quality of the reservoir. And this is what I want people to be very careful with. They are saying an estimated 11 billion barrels in oil has been found off Namibia's coast. Wrong, completely wrong. These are just estimations as to what could happen, assuming everything properly gets explored, everything is commercial, everything can be developed. As a comparison, Guyana right now is at about 11 billion barrels in oil reserves. And you're telling me Namibia in 3 wells got to that with no single developing well? And who said this? The energy minister of Namibia. Of course, they're going to make statements like this, bombast, optimistic statements to get people interested to go and develop these assets. So don't believe everything you see on the internet, especially stuff that comes from countries' energy ministers who are trying to get more investment in a global shortage of capex for oil and gas. India is kind of interesting. They have a few deep water blocks and ultra deep water blocks. They do have some production as well, offshore oil production, but nothing that really matters. And this is secondly important because the country's internal oil consumption is going up very, very significantly, and they don't have the production assets to back it up. Argentina, a few wells here that were drilled shallow, and you see how now the work is being done deep water. So we are moving more to the deep water as time goes on. Bangladesh, this is very interesting to me because when it comes to oil and gas capex, everybody looks for their piece of the pie. The Bangladesh offshore yet to find potential, according to Rystad, is 6 TCF. I just showed you a field, the South Pars and the North Dome field, that had 1,300 TCF of reserve, producible reserve. What is 6 TCF going to do? Nothing. So signal and noise. We as oil investors, especially as the time goes on, need to really focus on signal, get the noise out of our life, because it is leading to focusing on the wrong things and misleading information being spread on what are the main factors here to watch as this cycle continues. In any case, it doesn't even matter because Bangladesh gas demand is rising so fast that they will eat up any extra production from this field either way, regardless. Ghana, I mentioned this because it was on one of the news articles recently that they want to change some of the law, and they're forcing companies to pay tax that they supposedly implemented but nobody knew about. And yeah, 5 BCM a year. Nothing interesting. I mention it because these countries end up in the news and people make massive deals about it, and they're literally nothing. It doesn't matter to global oil supply demand. Not a factor. Australia, a country that used to have a lot of exploration, up to 70 wells drilled a year of exploration in the 2000s decade. And then it all fell apart. The discoveries ended up not being that good. The development was severely restricted by excessive political headwinds, excessive social headwinds, technical issues that they had on some of their LNG terminals, and constant delays to pipelines and development. And guess what? The investors just left and they went somewhere else. Sounds a bit familiar to some of the Canadian developments, doesn't it? Some of these previously UK countries seem to have a problem with this excessive social and political regime that they create in terms of the control they want on the resources and the development scheduling. At the same time, Australia has 6 million TPA of LNG spare capacity that comes online by 2027. So as their gas fields decline, they haven't invested in development or exploration. The LNG capacity of Australia is actually going down. So when you look at factors that say LNG here is coming up and it's going to oversupply the global market, there's other areas where LNG capacity is actually going down already because they don't have the right production. So always take a global view on things and then dive deep into the singular factors rather than just taking one supply. Somebody saying we have too much supply. Well, what about demand? What about inventory? What about capacity? We have to look at all the factors that are there. Decommissioning is a problem. So ExxonMobil has about 250 offshore wells they have to decommission in Australia by 2026. Offshore decommissioning is a big deal. Don't let it fall off your radar. It can become a nightmare for small companies. This is not the same as ARO or any sort of onshore decommissioning. Offshore decommissioning is full-on platforms that go subsea, that have technical problems possibly, that need to be dealt with, or else your entire operation gets shut down. So definitely one to watch, especially the fixed platforms, which are much harder to take out. There's some really good videos on YouTube on offshore decommissioning. If anybody's curious, I believe Shell and BP have some on their really cool videos, how they decommission offshore. It is a project and a half. Okay, so yeah, Albert makes a great point about the previous UK colonies. That's a term I was planning to use, but just didn't come to my mind. So definitely some issues with production and development delays in those countries. Okay, we have about a few slides on offshore services, and then we'll wrap it up. Probably a very short Q&A if we're going to have one, because it's already 3.5 hours in now. So yeah, offshore investments by region. If you're going to be looking at offshore services, look at which companies are active in those specific regions that are getting the money. You see Middle East and South America are much higher than they were in 2019. Europe about flat. The rest are at or below 2019 levels. Quarterly revenues from offshore drilling by rig company. If you're looking to get into this part of the investment, I personally have zero interest in buying any offshore services or any services in general. But I know for some of the individuals listening, you thought, okay, we're going to discuss global offshore, so we have to talk about services. Here are the companies that make revenues and how much revenues they make and how much revenues they've made per quarter all the way back to 1Q 2019. Here's the contracted rigs per day. Number of rigs working is basically what it's tracking. And which companies have those rigs. Once again, this presentation will be on my website, so you can download the full PDF of it and have a look at your own sort of time, because I have no specific insight to offer here. I'm just providing information for those who can use it. Working utilization by rig. So we have about a 75% working utilization at this point. Keep in mind, you're never going to get to 100% utilization, because some will be under maintenance, some will be not ready for the kind of work that they're setting out to do, some will be moving to a different location. So 75% utilization is pretty good. Can we get up to another 10%? Sure, maybe more. Yep, but it's going to take time because some of these rigs are also cold stacked. So a lot of work needs to go in before they can be brought back online. Worldwide drill ships greater than 7,500 feet and the average day rates versus utilization. You can see how the day rates are rising. and the utilization is also rising at the same time. Average day rates by type of rig, we got floater rigs looking pretty good. We got jackup rigs, not that great. Looks like there's a difference in day rates between floaters and jackups and the supply demand for each at this point in time. How many rig contracts were awarded? Floater rigs, not that many, about the norm. Look back to 2012, what was happening in a true bull cycle. Jackup rigs, looking pretty good, yeah, but a lot of it is from Saudi Aramco in the Middle East and ADNOC in UAE. So very concentrated in areas where the average investor cannot get exposure to Aramco or ADNOC in terms of investment purposes. Maybe the service side is where you go. This is your hull and structure construction metal index. So the global metal price jacked up in 2021, came down, then went up again, and now kind of has stabilized in this 110 index range. The hull and structure construction index has not come down as much. So it is still a little bit more expensive to produce new ships, new drill ships, things of that sort of steel, let's say steel and metals, raw metals. Offshore service market activity indicators by period. So this is when somebody talked about the ordering the wellheads and tracking that. This is what I track. Service purchases, rig demand, XMT awards, installed lines, vessel demand, and then FPSO awards. You track this, it'll give you a really good idea when we hit the inflection points. And I don't even track all of these, to be honest. Like mostly it's the rig demand in terms of the backlog, the vessel demand, the FPSO awards, and then just well results and how they do for the most part. Here's your decommissioning liabilities. So in the next 8 years, there's about $128 billion of decommissioning liability coming that has to be done. So keep it in mind. Don't just let it escape your radar for offshore. For offshore, it's a big deal, especially if you own a small offshore oil company. Not the kind of position I would want to be in personally, but also we see companies making deals where they can buy assets just for taking on the decommissioning liabilities. If they can produce them and make a bunch of oil in a higher oil price environment and then decommission it, maybe it's an opportunity. Once again, it's not a model that I invest in, so I don't have any specific insight to offer, just some thoughts. And with that, I think we'll wrap it up. So yeah, once again, for anybody that maybe has joined late or didn't listen in, this today's presentation was more informational focused, with me just providing information, aggregating data into one presentation. So people that want to know the latest and greatest things to watch for, some of the graphs, some of the tables, can have a look at it in one place. I will say that the offshore world is quite interesting in that a lot of the fields have their own PDFs and papers written on them, so that you can really get a good feel of what it is, how it was developed, what the exploration looked like, what the development looks like, what the geology is. Very interesting from a technical focused investor, because we don't have the same kind of depth of reading material on the onshore world. So definitely cool from that standpoint. I also said this before, offshore, especially deep water and ultra deep water, are going to be your source of supply if we want to balance the market going forward. It's either that or it's oil sands. I don't see any major oil sands growth here in the next couple of years as the decade continues. So, that's your one thing to watch. The other one to watch is deep water offshore. So hopefully today's presentation provides some key areas to track, key wells to watch, key companies to be focused on, and also what to avoid, because there is a lot of noise out there with focus on these things that can make 20,000 barrels, 40,000 barrels. It's just not meaningful enough to be spending our limited time on focused on those factors. So yeah, I think we'll do more of these as time goes on. I really enjoy learning more about these subjects and then sharing them, even though I don't feel like I'm contributing as much of my own experience and insight. It is something that people, I think, like to learn more about and enjoy. And then you can do your own research on any of the subtopics that you find interesting. So yeah, I think we'll continue with a few more of these. I do want to caveat that going forward, my presentation schedule is going to be a little bit subject to change. There are a lot of events down here in California that I would like to attend. A lot of them are, of course, weekend events, Friday, Saturday, Sunday. So I'm looking for the best mesh of information and also living a lifestyle that I would like to live and sort of investing around that. So yeah, I think let me see if there's some questions here, and if not, we'll end it. And okay, so Woodside still has significant potential in Australia. Yep. Yeah, there's potential in Australia. There's a lot of gas for sure, oil as well, onshore, offshore, but mostly the offshore gas and LNG. If they can get out of their own way, maybe something to definitely watch here going forward. Do you have any thoughts on Eric's surge comments? I'm not sure which comments you're referring to. He seems to be a shareholder at this point, so we will just kind of see what he does with the stock. Does he make it a long-term holding, or is it a short-term position for him? But yeah, I hope it's clear at this point that I don't really need anybody to back me up on surge. I am quite convinced and have a lot of conviction, and it's a company I track very, very regularly, have meetings with management as often as I can. Paul Coburn will be on Twitter Spaces April 6th. So we will have him on for a Q&A, just like we did with some of the other CEOs in the past. So a little update is on deck, and yeah, feeling pretty confident there are no issues with that name, or really for a lot of my bigger names at this point are performing and executing exactly as I said they would. I will be updating my portfolio shortly. Honestly, there hasn't been much changes, so there hasn't been anything to update. It's just the percentage moves up 1% or 2%, and the other ones move down 1% or 2%. So unless I'm making some sort of broad changes, I just haven't got to it. But I know it was last updated January 25th. So yeah, it's about 2 months in now. So I will maybe just change up the percentages for the sake of it and a more recent update. Any thoughts on the North American rig count increase? I will once again say this: the Baker Hughes count is not good. I don't like the Baker Hughes count. It does not have enough information in there to understand what's going on. I would use them as a 4-week average rig counts. But if you want a daily rig count, the Enverus rig count is really good. It's daily updated every morning. And sure, the most recent day is not the most accurate, but you get a better idea as to what's happening. So as far as I see on Enverus, the rig count is still going down in its declining sort of fashion. And 5 or 10 rigs is not going to make a difference between DUCs increasing or not. Permian supply is one to watch, yes. And I like to track Permian supply through JP Morgan and their live pipeline tracker, as opposed to using rig count as a proxy. But I'm seeing Permian production decline, yes. Not just stay flat, but decline. And right now, we don't have the rigs or the fracs working at a time when well productivity continues to drop in order to keep production supply continuing to increase. So when I see it, it will be the first thing on my Twitter feed. When I see Permian supply starting to now increase again, you will know about it right away, because it is one of my most closely tracked out of the various parameters that I like to look at. So yeah, April 9th, I have a presentation coming up on Colombia onshore and as well as the Vaca Muerta shale in Argentina. So really focused on getting people more information on where the supply can come in from and where the new barrels can come online from. So we've discussed offshore, we've discussed shale. We will now discuss some of the South American producers on April 9th. It may not be exactly April 9th, so don't hold me to it. Subject to change the schedule. I will also have a full Q2 schedule up shortly. There are a few things I still want to cover. I still want to cover some of my private placement investments more in detail, the timeline around that, kind of how that worked, how I got into those, what was my conversations, the negotiating part of it. I find is could be interesting to certain people who are more in some of the junior names. I have my Alaska focus session coming up as well. So I did want to talk about some of the onshore Alaskan acreage and do a very technical deep dive on the existing fields and then the new exploration that's going on with Pantheon and 88 and some of the other producers. So that's still on deck. I still have a Petra Ninja wells update that I want to do. There's been some pretty interesting wells that I want to track here once February numbers come out, and share more on those. And yeah, I think we'll just continue on with these, maybe with a less presentations per month. So instead of doing 3 or 4 a month, I might move it down to 2 a month, which allows kind of a good blend between investments and lifestyle. Yeah, I will be looking at Ecopetrol and every Colombian producer to the smallest producer that's publicly viable, to the point that it really matters, right? So I'll look at every private producer that's a big producer. We need to look at from a supply standpoint, and then we will look at all the companies that are in Colombia and Argentina, all the way down to the smallest ones from an investment standpoint, not purely from a supply standpoint. So, and people who know which companies I'm referring to will be happy, because I've got a lot of questions about these juniors that are in Colombia and Argentina. So yeah, so I think I'll end it there. Always fun. Always appreciate the questions and the people attending on Zoom. We're definitely getting to be, I think, a more technically focused group, which is quite important, I think, going forward, both from a investment standpoint and also from keeping our eye out for any major sources of supply that are coming online or could come online in the right technological innovation. So tracking all that as we go, becoming more understanding of the companies we invest in is always a good sign with investments. I've never understood investing in things that make no sense, and things where you don't have an edge. But again, I'm kind of digressing here now to my own sort of mandate, where commodities is a place where you can definitely have an edge in investing, whether it's macro cycles, whether it's company specific cycles, whether it's geology, company growth, subsector, offshore, onshore. You can definitely get an edge in oil and gas. And that's what makes, I think, it the most interesting sector to be in. So with that, I hope everybody has a great rest of the weekend. And yeah, we'll catch you here at some point or another on a space or on a Zoom or something else. So cheers.